Well, here we go. Cast of thousands. They keep dropping in. This is fantastic.
Hello, everybody. We're just letting everybody in. If you could just mute your microphones for us while we allow everybody to join. Thank you.
Okay, should I get going? Just a minute past 1. I think we're up to kind of 30 people on the call. I think there's more people are arriving as we go along. Okay, I'll tell you what, folks, we'll leave it just 2 more minutes as people are piling in. Okay, I think I'm going to get going. It's a minute past 1, coming up to 2 minutes past 1. So welcome everybody. My name is Sam Stevens. I'm your host for the day. We'll get on to housekeeping in a minute, but welcome to everybody to TBAT's Innovation Challenge Workshop number 1. We're running 4 workshops over the next 4 months, 1 a month, all of which are going to be fantastic. We've got some awesome speakers lined up, and this one is all about finance. I think people think they know a lot about finance, but I think there's still always more that you can learn and how to run a better and tighter company, raise the money you want, and get the right messages across. So I'd actually, if everybody can turn their microphones off, that would be absolutely wonderful if they can mute themselves. And if people can turn their cameras off, because I was on one webinar and one person left their camera on, and when we switched between presenters, all you could see was this one person, and they were picking the nose. So that would be really great if you can turn your cameras off, so you don't embarrass yourselves at some moment in the future. So how are we going to run this? I'm going to be introducing the different speakers. Ben, if you could mute your microphone, please, chap, that'd be wonderful.
Sorry, I've just been a bit late.
That's okay. Great to have you on board. I was running a workshop today with some school kids in Turkey, of all places. They're doing a renewable energy project, and they'd forgotten how good microphones are. And every time they scraped a chair or somebody went in and out the door, it was like echoing around this classroom. It was fabulous fun, but it was quite hard work trying to hear what they were saying. Anyway, there we go. So again, if we can turn cameras off, please, if you're not speaking. So we'll ask the speakers to turn theirs on for when they chat and when we do the panel session. So if you have got questions as we roll out through the workshop, please pop them into the chat. My colleague Joe will be keeping an eye on that and then feeding those through to me, so I can then intersperse questions as the speakers are going. It's a really great thing to do because it keeps the whole thing alive. We're going to start in earnest in just a moment, and we're going to have a 10-minute comfort break at kind of 2:05 for 10 minutes, and then again at 3. I know everybody's time is precious, and I want to try and finish fairly sharply at 4:30. What would be really great is if you can just pop questions in the chat as we go along, as I say, because that really does keep it alive. But from my own perspective, and I think for Joe's, we're really proud to be running the Innovation Challenge again this year after the last year's success. We had over 100 on most of the workshops last year. We had 50 companies apply to be in the challenge, and we had a fantastic awards ceremony in the June-July time where we had over 100 odd people in attendance, and we're trying to make it bigger and better this year. The actual Innovation Challenge will open towards the end of this workshop. So if you want to enter it, please do. If you know other companies that might want to enter, please encourage them to do so. A big thank you to our headline sponsor, Shakespeare Martineau. They're helping us with the sponsoring the whole of the Innovation Challenge, and also to today's workshop sponsor, which is Modus Accountancy. So Jenna Lloyd from Modus will be talking later on, as will Roger from Shakespeare's. I've done that. Okay, so the challenge. It opens today and it runs until the end of July. Joe will forward out a link of how to access that. There's a page on our website which you fill in some core details and you can upload a business plan. From the 1st of August, we will be looking at those, narrowing it down and announcing the 10 finalists ready for the event in October. So please take a look at that and put your hat into the ring. There's some fantastic prizes. There's a 5,000 cash prize on that, but also a lot of the people who have given up their time today to do the talks are also offering to do 4 or 5 days consultancy or assistance to companies as part of the winners package. And so it's a great opportunity to get some real expertise into your company as part of those winning prizes. Okay, why should we run a finance workshop? I've been in business now for over 25 years. And what I found out very quickly was that I knew about numbers, but I didn't really understand about finance. So a bit like Donald Rumsfeld said, as we know, there are known knowns and there are things we know we know. We also know there are known unknowns. That is to say, we know there are some things we do not know, but there are also unknown unknowns. The ones we don't know, we don't know. I mean, that's an absolutely superb quote, I believe. And it's absolutely true with business. There's so much you could learn about how to run a business, about all the different aspects. And I think for finance, what we don't want to do is tell you how to suck eggs. What we want to do is to try and educate you and make you aware of questions you may not know the answers to. So that's the whole purpose of this. So it's going through some key, really interesting stuff, giving you some hints and tips, and actually making you think, actually, I need to find out some more information on this. I don't know it all. So it's really about helping you grow your skill set within the company. Just before we get going in a lot of detail, I'd like to introduce to the speakers today. So there's myself, Sam Stevens, founding director of TBAT, Lewis Stringer, a fantastic gentleman at the British Business Bank, whom I've known for the best part of 20 years, I think it is now, Lewis, through various guises. We've got Jenna Lloyd from Modus Accountants, who are the workshop sponsor today. So she'll be talking about some of the core principles behind bookkeeping and why you need to keep an eye on that. Hugo Spowers, delighted to have Hugo Spowers. Congratulations on your MBE, Hugo, this year. Very well done for that. He's very kindly put his name forward to be the voice of the customer. This is somebody who's been there, done it, got the T-shirt, and he's going to talk about his journey and his company and securing funding to make it happen. We've got James and Rob from Rocking Horse. I think they've got a great proposition, which I think a lot of people will be interested in. And then we've got Roger Harcourt from Shakespeare Martineau, who's going to be talking about some of the legal things you need to be considering as you go around raising money and securing funding for your business. Just briefly on housekeeping, if people can, most people have got their microphones on mute. That is fantastic. And please, can you switch your cameras off if you're not on the screen? So that'd be great, because at the moment, Neil, I can see you picking your nose. So right, off we go. Over to you, Jenna. So Jenna's going to be talking about everything accountancy and really what you should be looking at for your business to make sure you're on top of your game. I'm going to stop sharing now and hand over to Jenna.
Thanks, Sam. I know we practiced this, but let's just can everybody see? Can you see?
Perfect, thank you.
Perfect, good. Good afternoon, everybody. Thank you for joining. My name's Jenna. I'm from Modus Accountants, small firm just based outside of Oxfordshire. Today really is just a bit of a whistle stop sort of headline of things you should be looking at this stage during your business ventures. Today I really want to sort of emphasize the point and get across that really the understanding your numbers should be the foundation of everything. So you know, you want to be able to go and have a basic understanding, be ahead of the game, and really use it as a tool for growth when you're talking to investors, when you're talking to other people that are presenting in the workshop, so if you're going to get grants or R&D tax claims. So really, I know the numbers are boring, but if you can have a basic understanding, get the foundations right, it's really going to do well for you. So what do we mean by sort of being numbers ready? And, you know, as Sam said, if you've got any questions, please do pop them in the box, you know, make this as interactive as possible. I'll be around for the rest of the day as well. So know your headline figures, really get to know what a profit and loss is, what a balance sheet is, and some of the key things such as a gross profit margin, operating margin. Now, you know, we don't expect you to know all of that, otherwise I'd be out of a job. So, you know, build a really good relationship with your accountant. One of the things that I really love is at the end of the year when I'm talking to clients is that they're not just seeing it as a compliance of, oh, we've got to file this and, you know, be tax compliant, etc. Really get to grips with everything. And I like to explain and go through the year-end accounts and make sure that they have an understanding rather than just here's the numbers and here's a tax bill. You can go on courses as well. Obviously, we're not going to go through, you know, what a profit and loss balance sheet is today, but there are courses available if you wanted to go and do that. Or as I said, build a good relationship with your accountant. Correlate your business plan with the numbers and cash flow forecasts. So one of the key things I work with a lot of startup companies is really just putting something in place. So you've got something to measure as you go along. So you've got a budget or a forecast. Most new businesses, as I'm sure a lot of you are probably experiencing, are very cash hungry. Cash flow is key. The old saying, cash flow is king. So you can really put together a good cash flow forecast. And there's lots of software or there's manual data you can use. And again, just working with your accountant to get out what you want and how you manage that going forwards. Keep up-to-date records. I cannot stress this enough. As an accountant, half our battle is that if you keep your records up to date, keep everything as you go along, it makes everything so much easier. So when you are looking at things like your business plans, your finances, you can easily manipulate the data. You can easily change different variables to whatever, you know, risks you've got going on, whatever control elements you've got going on. The more up-to-date information, the better. And I'll go on to a little bit about that in just a moment. Company setup and structure. I'm sure you may have already all set up your own businesses already, you know, being limited companies. At this stage, I would say keep it as simple as possible. So people get carried away with, oh, I need to have loads of shareholders, directors, I need to have a holding company perhaps. You don't need to have a different company for all your different activities at this stage. Keep it really simple. And also, you want to think about the number of shareholders that you've got as well. So obviously, when people are looking at your business, your third parties, you know, if you've got lots of different directors or shareholders on there, they might think, oh, you know, is there too many people going through the chain of command here? Is there too many directors or shareholders that have a vote or a choice in the decision? But likewise, you don't want, you know, mom, dad, your goldfish as shareholders as well, you know, just for tax purposes. So keep it simple, but think about who your shareholders are, because as I'm sure some of the other people running the workshop will go on to, at some point, it may be that you want to start giving some of your equity away in the company, some of your shareholding away. The way that you will raise finance will be either debt versus equity. So you need to start thinking, you know, do I have a lot of shares up front to start off with, a lot of low value shares? Because, you know, some of your control may be diluted as you go along. So again, Shakespeare will go through perhaps some of the legal side of that later as well, and what that looks like when you're trying to raise finance. And I'd say really the last bit on that is keeping really good board minutes and board meeting minutes and templates. You know, again, your accountant should be able to template those up for you quite easily, so you can see who the decision makers are. And when you're setting up, again, Shakespeare will probably go through more of the legals, but your articles of association, you know, how flexible they are as well, because a lot of this will be from funding, and a lot of the companies I speak to, you know, when they get, it's all very exciting getting that funding through to start off with, but you've got to start thinking about who's got control of the business and how that's going to get diluted. and also there's tax purposes, but that's definitely for another day, I think.
Okay, I've got a question there, Gemma. Got a couple of
Sure.
things. On your last one about keeping timely records, and I think you come on to this a bit here. I always remember stories of people going into accountants with a carrier bag full of invoices, and like just dumping it onto the table of the poor old accountant. So that is not ideal, is it?
No, absolutely not. And, we still get it. But nowadays, just coming on to that, there is so much technology available to be able to manage and track it. And, we acquired a firm not so long ago, and they were very paper-based, just like that, books and records, very reluctant to move on to more of an automated system. And actually, if you've got the right person to work with, so we spend a lot of time with our clients training and helping up front so that it's not this overwhelming thing, books, accounts, records, what does that terminology mean? We want you to be as educated as we are. Obviously, don't put us out of a job, but just have a real understanding and how to make everything more efficient.
Lovely. I've got another question, if I may.
Of course.
Somebody's asked sort of the difference or the benefits of perhaps registering as a social enterprise, so not for profit, or a standard registered company. Have you got any thoughts on that?
I think at this stage, I think it really is determining what the intention is behind your business. And that's everything that kind of pushes everything forwards. So what is the intention? What are you doing it for? What are you trying to develop your product for? Where are you trying to put it into the marketplace? And again, that will all tie back into your business plan, your business forecasting as well. Who is your target audience? Where are you going with this? So that does need a little bit of thinking about. And then it doesn't matter too much from a tax perspective, because you're either doing it for not for profit, for a better world, better environment, etc., or are you doing it because one day you want to put your feet up and be Elon Musk, whatever that may be. So yeah. I think you just have to think about it.
I've come across a couple of situations just before we kind of move on, is where people may have built an IT platform and it can be used in the third sector. So they set up a not-for-profit to run that in the third sector because that opens up the market opportunity, but then they can actually do a transfer of costs across into the limited company on a license basis. So you could actually have a feet in both camps that way.
Yeah, absolutely. And as I said, to start off with, keep it simple, so if you do start off with one or the other, that doesn't matter. There is opportunity to create, another limited company and cross charge. And that's it's actually better when it works like that because it's more organic. So we've seen some companies that start with the seed of an idea and it's very much a family business. And then, that may grow into something bigger. And that's when they start sectoring off the business or their ideas or the different segments because they don't know at such an early stage of where things are going. So yeah, there's always opportunity to change things. Any more questions before I move on?
No. Sorry, I keep interrupting you. Do carry on, please, Gemma.
No, please do, because otherwise I feel like I'm talking at people. So records management, it sounds very boring, but as Sam said, it's an accountant's nightmare when you come to us just before the filing deadline with a carrier bag. Please help me. I need to show, this third party that I can raise this finance or the numbers of this or my budget's that. It's no good. You need a good foundation, good working relationship from day one. I would recommend getting some accounting software from the very start. So it is an extra cost, but if you can get to grips with it, it's going to do you so much better in the long run. One of the main ones, you probably heard of things like QuickBooks and Sage. One of the main ones we use with clients is Xero, purely because it's so user friendly and it's quite nice to manipulate the data in. Dext, going back to Sam's comment, it's like a virtual carrier bag. So if you're still holding on to those receipts, it's quite nice, Dext, is to have that virtual carrier bag where you can put everything into. Because at this point, your time is so much better elsewhere, working on your product, working on the innovation side of things. It's quite easy to let this part of it fall aside. So really get good accounting software, invest in that cost, get the data right from day one. Clear and accurate bookkeeping, revenue versus capital expenditure. So what do we mean? putting things in the right place. So again, it's just taking that time up front to really understand the numbers and where things fit together. So, you know, we're putting costs that are a one-off cost in the profit and loss, so we can truly measure what that profit is looking like. We can truly create those cost cards and what it's costing you. Versus the capital stuff. So when you start looking at, you know, your intellectual property, when you start buying plant and machinery, that kind of equipment. So when you're looking at the data, it's real. We can have live discussions about it. So quite often with some of my early setup companies, you know, we can go into Xero together and we can start having that discussion of what goes where, and they can get on with it then. You know, they're quite happy to do it themselves. You don't, you know, need hand holding all the time. It makes sense. It's not this overwhelming task at the end of the year when you're scrapping to do a bit of compliance. And the quite nice thing about that is these, you know, software such as Xero, you can track those R&D costs. So when you're going to, you know, TBAT and saying, I want to make an R&D claim, you're not trolling through lines and lines of spreadsheets and, you know, something makes sense to you that doesn't make sense to us, that doesn't make sense to TBAT. We can all be on the same page. We can run a report in Xero for all of the R&D costs that we've tracked, present TBAT with a report, off you go. It just speeds everything up so much. And exactly that when you're doing, you know, going for investment, or whether you're going for, you know, debt finance, etc.
I think it's on the tracking of your accurate bookkeeping. People do. I've had a chap come to me, Colin, and he had this fantastic business. He said, I'm looking to raise some money. And I said, okay, Colin, let's have a look at you. How much do you need? £100,000. So he showed me his cash flow forecast. He says, I've spent ages building this. And I said, it's all very interesting, Colin, but all you've done is the profit and loss. You've said when you're going to invoice in and out, and you've actually put all your capital costs in there. And actually, if we sort it all out and make it into a profit and loss, a balance sheet and a cash flow, you actually need £250,000.
Yeah.
You know, and at which point we went and managed to secure him £300,000 to get his business up and running. So that was great. But, you know, understanding and getting it set up, where does my money need to be posted for me to have an accurate understanding of what's happening in my business? Really, really important. And I think if you're there to help clients get that set up initially, that's a real bonus, because some accountants just don't do that. They're a bit old-fashioned.
Yeah, exactly. And it's just about, it's the exciting part of our job, you know, when you care about what somebody does and you get involved and you get excited about it. You know, I've got a few clients, I know exactly what phase they are with their development of their product, and you know, it's really exciting to see them grow as well, because that's the satisfaction that we get when we can help somebody grow. And it's so easy to get caught up in the entrepreneurial spirit, the idea of it, but actually you need to be on the forefront when you're going to people and showing off a little bit and saying, I have an understanding, I've got a grip of my numbers, I know that if X was to happen, then this is going to be the impact. That's what, you know, third party companies like. And as you say, can we get more money as a result of, you know, keeping accurate records? Yeah. And, you know, that kind of goes on to my point about managing cash flow and working capital. So many people will either get so caught up in the profit and loss that might not be right. That doesn't necessarily mean the cash in the bank is all of yours. And some people get so caught up with the, you know, the cash in the bank that they forget about everything else that's underlying the business, you know. So you've got to really put that hat on, not just the entrepreneurial one, but a business owner one now, or even if it's not for profit, you know, that kind of management head, if you like. Working capital, again, is just keeping enough ticking over in the business. So as I said, it's so cash hungry, you're putting a lot of outlay to start off with. So quite a common thing in startup businesses is something called over trading, where you get so excited to fulfill a contract, but actually you don't have the underlying cash or supply or resource. So having, again, good numbers, good budget and forecast, you can actually understand if you can commit to a certain contract and provide that product. Is it ready for market? You know, can you put that out?
I think, Gemma, people often forget that people you sell to may not want to pay you for 60 days. Although you say you need to pay on 14 days for my invoice, they'll then make an excuse, well, 14 days month end, but our payment runs at the end of the month. So all of a sudden it's 60 days till you get your money. and yet people who supply you, because you're a new company, you've got no track record, you need to pay with it straight away on the day before they even send it to you. So as you grow your business, you can see that that gap and that time delay of getting paid gets bigger and bigger, and that's why you don't want to overstretch yourself. That's why as you say, the importance of modeling what you're doing and where your money's going.
Yeah, exactly. And that's why, you know, again, going back to the software, if you can get the basics right, the rest of it is just overlayering on top. So you can manipulate that case scenario, for example, but you can't do it if you don't have the fundamentals right. You know, and that's going back to time management as well. It's a lot easier if you can do things as you go along, because, you know, if you're like me, if somebody asks me what I did 6 months ago and where, you know, that bit of paper is and why that decision was made, what were the figures at the time, and you've got loads of spreadsheets going on, it probably makes sense to you, but it needs to be readable and understandable for everybody else as well. So you don't want to spend so much time at the end chasing yourself. You know, keep things as simple as you can going along, keep track of all of your paperwork, you know, whether that's at home or using some software, any agreements, because your time can be spent elsewhere rather than playing catch up. And finally, just a little side note, you do have to be aware of the VAT threshold. So once your turnover is 85k or more, you do have to be VAT registered. You can backdate a VAT registration, you know, put a backdated claim in for goods and services. So again, there's a decision up front of whether, you know, what your business type is and whether it makes sense to be VAT registered or not, who your customer is, you know, does it make sense to be VAT registered or not? So just another little thing to keep an eye on.
Yeah. Okay, we've got some questions coming in here, Gemma, which is great. So somebody has asked, let me just slide back up. Can I ask which accounting sector would body membership come under? I'm not kind of familiar with that term. I don't know. Jackie, if you could put a little bit more detail in there, because it's not one I'm familiar with. Yeah, Gemma, are you? I'm not quite sure.
No, sorry, I don't.
Okay, so we'll come on to that in just a minute. There's a new message just pops in, and then another person has kindly asked, do you give guidance on what parts of R&D is capital versus expense? So do you want me to take that one?
Yeah, I don't mind.
I'm going to be talking about R&D tax the very next chat after this. Just how exciting is that? So yes,
like we planned it.
So there's the answer to that is capitalized R&D can fall into two areas. There is equipment for R&D, which is if you like, a fixed asset, and that has to go on the balance sheet typically if it's above a certain amount, and then you depreciate it over the years. So there is no specific R&D tax claim on that, but the legislation says in the tax computation you can write it off all at once to actually generate a whole load of cost in the tax count to reduce your tax bill. So if it's a fixed asset, you can do that. Likewise, if you're developing a piece of software or a software platform, you might capitalize that as an intangible asset. So you've taken the cost out of the P&L. So that makes you look like you've made more money, and you've put it on your balance sheet. So it makes you have a stronger balance sheet. And that's recognizing the IP that you've generated. But you can then work with that in an R&D tax claim through the tax computation and still get all the benefit as if you'd left it all in the expense. So it's a bit of a tricky subject, but the answer is, between ourselves and Gemma, we can certainly guide you through that process. And putting stuff to the balance sheet can be really, really good for a company because, as you say, it's adding value to the company instead of just writing it all off in the P&L. Again, yeah. Go on, Gemma, sorry.
Yeah, I was just going to say absolutely. And one of the things that a lot of third parties will look at, and it is slightly changing at Companies House soon, there's going to be a lot more disclosure. So it is going to be even more important to what goes in the P&L and on the balance sheet, because the balance sheet is what they look for the company to be solvent. So yeah, there's going to be a lot more disclosure soon. So that's why it's important to, you know, an accountant shouldn't leave you at your own will. You know, it's a team effort. It's a joint thing to be helping you, you know, where to put things. And you've got obviously people like Sam as well that can help with that.
Okay, so can you claim your VAT back from HMRC if you're not VAT registered?
No, you can't reclaim. If you're not VAT registered, you can't reclaim the VAT back. However, if you're not VAT registered from the start, but then you do get VAT registered, you can go back as far as 4 years for any goods that you've still got on hand at the date of VAT registration. So that's why, again, keeping the paperwork for all of those larger assets that you would be purchasing, it's going to be easy to do a VAT reclaim when you do become VAT registered, because you'll have it there ready to go, rather than, again, digging through boxes and carrier bags 4 years later trying to find, you know, to claim a few £1,000s back on a bit of equipment that you purchased. And you can claim for services as far back as 6 months as well. So there is still an opportunity to reclaim.
Yeah. The bit about the body membership, that I think that was if you were to set up a trade body, I suppose you can actually, it's up to you what you want that to be, whether you want it, you're going to run it as a sole trader, whether you run it as a limited company, or whether you run it as a not-for-profit. And it all comes down to the underlying terms of how you set that company up, isn't it? So I think it depends what you want to do with your membership and whether it's for profit or not.
Yeah, absolutely. And I think, you know, even if you're not sure, you know, have a chat with somebody. Again, it always goes back to the intention. One of my first sort of conversations with a client is, what do you want? What is this all about? What are you doing it for? You know, what are we getting up every day for to do? Is it for growth? Is it because you've got a passion project? You know, what is it for? And then you can decide, you know, whether you go limited, not for profit, whether you do, you know, small local things. So most people will go limited company, and again, not to go into it today, but it is its own separate legal entity, so you're kind of giving arm's length to that business and letting it, you know, manage itself. And as I said, once you start talking about the debt and equity and shareholders in the business and really pushing it forwards, and how you want to protect yourself legally as well, then yes, most people will choose to go limited. Yeah.
And just by the way, folks, Roger has kindly put some bits and bobs in the chat about trade association. So so Roger's one of our speakers from Shakespeare. So there's hopefully there's a bit of okay, we'll move on. It's fantastic, all these questions coming through, but we'll move on with yours, Gemma. I'll look to do mine, and then we'll do a Q&A at the back end as well. So please keep asking questions, and we'll try to come with them as we go through, but if not, save them till the end.
Yeah, absolutely ask questions. I know accountancy is probably not the most thrilling for everybody, so but I'm yeah, as many questions as you like. So as I said, today really is it's not a teaching lesson. It's, you know, not tax planning or anything like that. It's really just to get across the importance of get it right, get the understanding from day one, because everything is going, every decision you're going to make is going to come back to the numbers at some point. So just have it as the business owner, your own understanding, get that basic knowledge, manage your cash. Manage your cash. You know, this is going to fuel you along the way. As I said, one of the things that happens is, you know, can be over trading. How do we fulfill contracts, etc. And that comes on to what Sam mentioned about lengthening string and, you know, supplier contracts, about that time lag delay. And I've actually seen it. So some people might think it's so much cheaper to get something in Hong Kong, but actually by the time you've paid them, because they want quick payment terms to release the shipping, you know, that could be 30 days. Then you've got another 30 days that's being shipped across. So your 60 days sort of supply chain is so delayed, and then you've already paid for that, but then, you know, your customers are not paying you either, even though you might have, as Sam said, the 14-day terms. They might not pay you for 30, you know, to 60 when you can actually deliver that product. So that supply chain can become very long. So always look at, you know, payment terms and conditions. Most third parties will want that 2 years history of credit before they'll offer it to you. So again, if you can go to them with the concrete numbers, they're more likely to listen to you. Again, and the final point is, final 2 points, stay on top of your records from day one, get rid of the carrier bags. I promise you won't look back if you can ditch those. You know, spend the time up front understanding everything, you know, work with your accountant. You know, they shouldn't charge you on the clock every time, you know, you pick up the phone, etc. You know, build a good relationship with them, and think about finally what your business needs. So ultimately you're juggling a lot of balls, okay? So you really need to be set on day one what your intention is, what you're trying to achieve, and how you're going to get there. You know, and as Shakespeare will go through, there are ways of raising finance, you know, whether that's debt or equity, you know, dilute some of the control in your business. You know, I have worked with companies where they haven't realised until it's got to, they came over to us from another set of accountants, and they hadn't realised that they'd entered into this, you know, Cedars agreement, which, you know, Cedars are great, you know, but they hadn't realised until they'd actually gone into the agreement what it meant financially for them. They just saw cash coming into the bank, but they didn't realise how much control they'd lost in their business, and they felt a little bit sour about it afterwards. And also they didn't realise they had to put money in themselves. It was just never explained properly to them that they actually needed to cough up quite a few £1,000s in order to get some money back in the first place, which, you know, seemed a little bit counterintuitive. But it's those kind of things, you know, that support that you need. And that's why these kind of workshops are really great. You've got a taster from each sector, basically. So think about your business needs. Be in control, let you be the decision makers, and you're going to feel so much more confident if, you know, the numbers are right and you're a bit more prepared. So that's my main message from today.
Yeah, Gemma, that has been absolutely brilliant. Thank you very much indeed. So just so everybody knows, the contact details for the speakers will be circulated later. So if you've got, if we've not managed to answer your questions, please get in touch with them directly. I'll say at the end of each kind of double treble session, we have got a Q&A. So hopefully we'll have time to come to that. So Gemma, if you could stop sharing, please.
Yeah, thank you.
I would give you a round, well, I can give you a round of applause. Well done. Thank you very much. Brilliant.
I've got to stop sharing it now, haven't I? You're going to ask me how to stop it. Here we go. Big cross button.
Yeah. Thank you, Gemma. Catch you in a bit.
Thank you.
Right. Okay, folks. After that fascinating talk by Gemma, thank you very much indeed for that. So that was all around how to control the money in your business and what you should be doing as soon as you can on that. I'm going to do this in 15 minutes because that bit was fantastic, but I want to try and stick to schedule. So I'm going to talk about grants and research and development. So let's click onto here. Okay, the UK has actually got quite a number of different organisations that do provide government funding into companies. I know what's going to happen here. This is going to be an automated one, so this is an absolute nightmare. I'll tell you what I'm going to do. I'm going to stop sharing, and I'm going to bring that one onto here. It's all about not being phased when you're under pressure. There we are. Okay, so hopefully you can see that. And that won't now flick through without me knowing. So the UK is brilliantly well off. You know, the government does understand that if we're going to succeed as an industrial nation, they need to make money put aside for innovation. And these are just some of the funding bodies that are available here in the UK. So we are pretty well off. Few issues with the Horizon Europe at the moment, but I'm hoping with the so that's basically all to do with Northern Ireland. The Europeans have said you can't be part of Horizon Europe until you sort out Northern Ireland. The Windsor Accords or protocol, whatever it's called, should hopefully sort that, and then we can be back in Europe. We need to be back in Europe from an innovation perspective. Okay, what is grant funding? It is free money, and it's provided by generally the UK government to help you innovate and move your business forward. Typically comes in three flavors. There's little consultancy type projects, which might be funded by trade bodies, your local economic partnerships, government, local government agencies, and that sort of thing. There is then capital project grant funding. You don't see that so often now. In a nutshell, for every job you create, they will give you £10,000. And they will only give you 20% of a project. So if you spent £1 million, they might give you £200,000 towards it. They actually want you to generate 20 jobs, which is a bit of an oxymoron when you think that they want the UK to be more efficient and effective. So actually, I might want to invest in this piece of kit, so I don't need so many people. So anyway, that's not for me to comment too heavily on, but the bulk of the grant funding in the UK is around innovation, and that's helping companies move forward and fund new product development and research. And the UK is pretty well off. What's great, it's free money. As long as you don't spend it on your holiday island in the Caribbean, it is free money. Quite often we have clients securing Innovate UK grants, And on the back of that, it triggers equity investment because Innovate UK have done their own little bit of due diligence. And they've said this is a great idea. And by the way, we think the numbers stack up. That's a big tick in the box for investors. Another really important point is this stimulation of collaboration. It's all right developing a product on your own, but if you've got members of your supply chain as partners and maybe an end user, you've got some market pull, it actually means that you're developing something that the market wants and you're getting the proper support from your supply chain to make it happen. And of course, it stops you investing too much of your own money because the grant's going to come alongside. In round numbers, a small and medium-sized enterprise below 250 people will get around 70% funding on these types of grants. So that is really terrific, that is. So there's some bits there. The grant funding landscape. So predominantly Innovate UK are the gateway for people to access grants. So they would look after it on behalf of the SBRI, Small Business Research Institute. They might looking after some of BEIS, one of the government business departments, etc., etc. So they're a great place to look straight away. So here's just a bit of an example of the cadence of grants that are going to be coming through over the next few months. Innovate UK is really good at putting information out a month before a scheme opens. And when it's open, it's typically open for about 6 weeks. I think they could do a lot better. I think they could actually let you know 4 months in advance what's going to be coming up. And hence you've got 4 or 5 months to actually get your act together and do a strong application. But that's their decision. I think they could improve that. However, they do put the best part of £300 million out as innovation funding into the UK economy, and it covers all manner of subject areas and technology areas. And you can see just a few of the examples there, a bit around farming, there's a bit around at the moment around greening the marine industry, APC, Advanced Propulsion Centre, that's all to do with electric hydrogen vehicles and getting those into the marketplace and improving the technology. The kind of the signature grant scheme for the UK is the Smart Grants, run by Innovate UK, and they run typically 4 competitions a year. I think the first top one there, which meant to end in mid-April, they've left it open now till the end of June or middle of June, so they've extended it by 2 months, which kind of says to me they're not going to run quite so many competitions in a year of that type, which is a real shame because that is a catch-all for everything. So yeah, quick question. Innovation loans. Innovation loans are funding from Innovate UK. You do a technical application and a business plan and a cash flow. Typically they charge 8%, 7 or 8%. They do give you a year or a year and a half drawdown period where you can draw the money down as you need it, and they roll up the interest that you pay, and then you have a year interest only up to, and then after that you do have to pay it back. We are in discussions with Innovate UK how they kind of have galloping goalposts on what is a good financial model for their innovation loans. They choose not to tell anybody what they're actually looking for, but we are in discussions with them to try and improve that situation. So there we go. For a lot of new start companies, they think, oh, fantastic, I'll get an Innovate UK grant, boom, off we go. You do need to understand that you have to fund all of your project for up to 4 months before you see any money out of Innovate UK. So there's a couple of examples here. If you just look at that first column, 250,000, you get a 70% grant, you're going to get 175k. But because you claim quarterly in arrears and then it takes a month to get the cash, you actually need 80-odd thousand pounds to bankroll your project to get it underway until you get your first money coming in. So you do need to be aware of that, and you do need to think and prove, how am I going to fund that? So there's just some examples there. It's quite an important note, that is. Eligible costs, quite a broad church of eligible costs. Labour, that has to be pay as you earn. Subcontractors, you can also have externally provided workers where you have contractors working direct for you. Subcontractors where you throw it over a wall for somebody to do on your behalf. Innovate UK say for every £1 you spend on labour, they'll give you an extra 20p to kind of cover the running of the business in the background. You can have material costs as you buy stuff that you consume during the project, that gets covered. They're rubbish on travel, but they do give you a little bit of travel allowance. And then if you've got a big bit of kit that you use in your project, the depreciation of that as you roll out your project, you can claim that as a cost in the company as well. So it's pretty good, really, I reckon. They've obviously evolved this over time, and I think what they offer now is actually quite good. And things like cloud services and data sets, they're all allowable costs on this as well. They have changed this slightly for Smart. I think there's only 7 questions now for Smart, but traditionally, and for a lot of applications, 10 key questions, and they're the ones that you have to do. Quite often the guidance is actually longer than the answer space that you get. Typically you get 400 to 600 words to answer these questions, and it's really important that you try and answer the questions in the order that the guidance is actually asking them. So on risks, it'll be talk about the technical risks, the management risks, the commercial risks, answer it in that questions. And it'll say, we would expect to see what is the risk, what's the level of the risk or the mitigation, and who's responsible. Okay, that's what I need to do. They actually tell you what they want. But if you answer it in that order, when the assessor comes along, he's got his little tick box. He says you've answered it in exactly the right order. It's a lot easier for them and more positive for them to, as an experience, likely to score you higher. Just out of interest, on Smart grants at the moment, you need to be scoring over 85% typically to get supported, which is absolutely bonkers. But that's what it is. It used to be 70, 75, it's crept up to 85. On other grants, my top tip would be, if you spot a grant that is in the technology area that you're doing, go for it, because it'll be the same amount of cash overall available in that scheme, but there's less people applying for it, and you're more attuned to what it is that they've written, that what they want in the scope. Whereas if you leave it in Smart, everybody's applying in for that. So try and identify grant schemes that meet the technology that you have. Other top tips, my favorite one is make sure you have written and built a project plan ASAP. That is the piece that actually identifies who's doing what, how long it's going to take them. It drives out the deliverables, the milestones, the resources. From that, you can derive the innovation and the technical risk. If you've got a good project plan thought out, then you've actually got 2/3 of the application in a form that you can actually now rewrite it to suit. I talked about collaboration. Get them on board when you're creating the project plan and get them to sign off and commit to it. The worst thing that can happen is one of your major partners drops out last minute because they're not really bothered. So let's try and get them hooked in very, very early on. I've talked about answering all the questions and the bullet points. Avoid using acronyms, of course. We generally say if it's less than 4 weeks until a deadline, we're not going to be quite so interested in helping companies, because it's really tough to do a strong application in kind of less than 4 weeks. So do leave plenty of time to write these. And when I talked about the different themes of competition, the different flavors of technology they want to support, they have a very clear description of what the scope is. Make sure your project meets the scope, because if it doesn't meet the scope, then they'll just cut it out as soon as they look at it. They'll say that doesn't meet the scope, boom, you failed. So it is a really tough old game, but it can be well worth it. So when I'm talking about partners share a chunk of the contract with Innovate UK. So each partner would end up being an applicant. So it's like that. A subcontractor sits under one of the partners, and they just get paid for doing the work that they do by the partner. So partners have got sort of meat in the game on these. So they're great to have on board, but you need to get them committed. So yeah, the scope question, that is advertised really well, and just make sure you actually do meet it. Another top tip, try not to manipulate your project or your technology to fit a particular scope, because you'll end up being forced to design and develop something that perhaps you don't really want for the market you want it for, but you're just chasing the money. You might be better off waiting for an appropriate call to open and then chasing the cash at that stage. Okay, so that's it on grants for this. Like I say, I'm trying to rattle through it a little bit. Yeah, my details will be out there, so please get in touch and ask loads of questions on the chat, and we'll go through that. R&D tax credits. They've taken a bit of a battering recently with HMRC saying there's too much fraud in what's called the SME scheme. So to tackle fraud, they've just reduced the benefit to everybody. What they've actually not done is tackle the number of cases of fraud. And they've been hauled up in front of the House of Lords for that, basically saying you just penalised everybody and actually not tackled the problem. But hey ho, there we go. It is still a very generous scheme for companies who are innovating to retrospectively claim a reduction in their tax if they're profitable, or a cashback based on the work that they've done. And if you're doing any level of technical work in your company that really makes you scratch your head, it's worth looking at whether R&D tax credits are the way to go. There's two key schemes. There's the SME scheme, and bizarrely enough for this, it means below 500 people grants. It's below 250 people for an SME. And you can see what the current benefit is there. So if you make loads of profit, every pound is worth about 25p off your tax bill. And if you're loss making, you can claim up to 33 pence in the pound, which is fantastically generous, I reckon. And you can go back 2 full years. So if your year ends end of April 2023, you can look at years ending 22 and 21. So you can go back 2 full years and the year you're in. So if you've paid tax before, or you're cashing in losses before, you could end up with quite a healthy chunk of cash coming into your company. Jane, just by the way, we will be sharing the slides at the end of this. We'll, I think we're going to do it as a link on an email, so you can actually then go and download them.
Okay, thank you.
But great question. Thank you for that. The RDEC scheme used to be the large company scheme, not quite so generous, kind of 10 pence in the pound, and that can be claimed by large companies because it's what it's there for, but also small companies, SMEs, who have done work on behalf of somebody else, or they've had a grant of some description. It opens the opportunity for RDEC. So as an example, if you have a Smart Award from Innovate UK, you can claim up to another 10.5 pence. So you're actually getting over 80% towards your project. I mean, it is really, really good. The autumn statement last year, they thought we're going to rejig all of this because of this fraud issue, but also we want to make it fairer for large companies. So in the click of a switch, I'm now showing you the latest ones moving from April this year. So you can actually see, and they're also, government's also putting in a new tax rate. So it's 25 pence in the pound if you're over £250,000 of profit, which kind of muddies the water somewhat, but never mind. So the benefit now, if you're profit making, is anywhere between sort of 16 and 22 pence instead of 25. But if you're loss making, it used to be 33. It's only 18p now. So that's a real blow for new start companies. They've kind of rescinded on that just a little bit by saying if you are an R&D intensive company and you spend more than 40% of all your costs on R&D, we're going to make that benefit if you cash in your losses a little bit better. So they have recognised that they've gone too far, and we're kind of destroying the entrepreneurial nature of the British economy. But the large company scheme is heaps better. That's gone up by over 50%. So instead of 10p, you're looking at 15 pence in the pound. And the beauty of this for large companies is it's what's called an above the line credit. So it sits in your profit and loss. And so if you're part of a big group overseas, they can look at the UK company and go, oh, look, what's this income line here? Oh, that's the RDEC scheme. Oh, that was worth 150,000 to us. UK is a great place to do business. So they're both great schemes. It's a shame the SME one it's taken such a battering, but it's still really, really good compared with some of the international jurisdictions you could go to do R&D. Well, there are other changes. So I think from the 1st of April, things need to be submitted electronically and not by, you used to have an option of either paper or electronic, but then the actual claim paperwork needs to be submitted electronically now. Before, a report was not legislatively required. Now it is. You do have to supply supporting information on your claim. If you've used somebody like TBAT, to write a claim, then you need to tell them that you've done so, which I think is absolutely great and transparent and is how it should be. And if you do use an agent, top tip, make sure they ask you to undertake an AML, anti-money laundering check, like you would do with an accountant's and a solicitor's. If they don't, they are breaking the law, because they are essentially giving tax advice. And if you're giving tax advice, they have to comply with the AML legislation. A lot of our competition choose not to do that, and I'm surprised they're still in business. Now, a company director or named person in the business has to sign the claim off. If you've never made a claim before, or it's 3 years since you've done it, you've got to pre-notify HMRC that you're going to make a claim. And they've actually included the costs a little bit wider. And there's a slide on that just coming up. But essentially, it's PAYE, it's material costs, subcontractor costs, and you can now have web services, data sets, and software. You could always have software as material, but now it's data sets and web services, which is great because it's actually recognizing that the world's moving forward, and it's only taken them 25 years to catch up. So well done, HMRC. Eligible costs, I've just touched on that. There we go. A worked example. You can see in this quick example, straightforward R&D tax claim has saved them £5,000 on their tax bill for only £20,000 of R&D costs. This is why you need to be doing it. And in the third column, if it's loss making and you're cashing in at 33% for last year, it's worth 6,600 on your 20,000, which is absolutely fantastic. And I often say to companies, you know, if we get you £100,000 of benefit and you only make £1 million net profit, I've put 10% on your net profit for 5 days of your help. Where else are you going to get that kind of day rate from anybody? And if you had to grow your company by 10%, what would be the pain to you? So this is a really fantastic way of rewarding companies who do R&D. I think I've only got 2 or 3 slides on this now. So timeline, as I say, you can go back 2 full years. That clarifies that. What's great about R&D tax credits is they've notionally got a budget, but it's non-competitive. So if long as your claim stacks up and it makes sense and it's well evidenced and it's well balanced against the money you're claiming, it will get paid. They don't run out of cash, which is great. Depending on where you are in the cycle of your business and how many years you're claiming for, you can either reduce your tax bill looking forward, or it will give you cash back to spend today. And that cash allows you to invest in future R&D, which is what this is all about. It's rewarding you being entrepreneurial and being innovative in your company. HMRC are doing, can you claim R&D when you are paying PAYE? Yes, so salaries do need to be pay as you earn. So what some companies do when they're very early on, they don't pay directors. And this was a question earlier on about in-kind help. Kind of both grants and R&D tax, to claim the labour element, you have to be pay as you earn. You can't, you know, just make out that I'm worth £50,000 a year. So it does have to be PAYE, and the R&D claim means that you have to be pay as you earn to rack up the labour costs as part of the claim. So yeah, you pay your PAYE, but then you get some money back on the R&D tax claim. What some directors do, they make out they've paid themselves £30,000 a year. They've paid their national insurance and PAYE, but they've put it into an R&D tax claim, so they basically get that money back. But they've now got £24,000 of directors' loan in the company that they've paid tax on. So it is a way of actually generating worth in the business for you as a director, which you can then, when the money's in the company in a future time when you're profitable, you can take it out without paying tax. HMRC enquiries, they are, where are we? I've lost my mouse. Here we go. Brilliant. Okay, HMRC enquiries. They are doing more and more, and generally kind of 1 in 10 claims are being looked at. So, you know, and I think this will cut down a lot of fraudulent claims, as in one of our competitors said, oh, we do really well at old people's homes. We make such big claims on the design of corridors and the paint colour schemes. And I'm thinking, what a load of tosh that is. and they deserve to have an HMRC inquiry and taken to the cleaners. But if you've done bona fide R&D and the numbers stack up as being appropriate, there's nothing to fear of an inquiry. And we've been very successful at supporting our clients who have had inquiries open on them because of the quality of the reports that we put together. You can overcome that by the BEIS guidelines, a bit of a dull read, but if you Google the BEIS guidelines for R&D, it's the guidelines that HMRC use to understand have you done R&D or not. So they are worth keeping an eye on and trying to understand as a heads up, is the stuff I'm doing, is it eligible? So it's worth a quick look at that. And then my top tips. So start your claim early. So with some of our clients, we actually go in a month before their year end. And so it's all ready to go when their year end finishes. They've teed up their accountants, it goes in a month later. If it's a cashback, they might get that 6 weeks. So 10 weeks after their year end, they're getting that money back. And I know Rocking Horse are going to be talking about other ways of releasing money later on this afternoon. So it's really good. Get your claims sorted. Try and actually be making notes and recording your R&D as you go along. Really good thing to do. I've talked about the guidelines. Using an agent, if you are using one, as I say, get them to do an AML check because it shows that they're being professional. Quick question, can you claim R&D if already in receipt of Horizon funding? So Horizon Europe, Horizon 2020, I believe is notified state aid. So that means you can claim a further 10% on top of your costs, as long as they're eligible from, so you'll be claiming under RDEC, and in RDEC you can't have subcontractors like you can in the SME scheme. So you'll be claiming under RDEC, so you're only really looking at externally provided workers, salaries and material are the three key bits there. No, so you can claim labour costs as well, is another question. Can you claim for non-labour? Yes, you can. So as I say, it's pay as you earn labour, materials, software, web services, that sort of thing. And another top tip is drive your accountants to get your accounts done ASAP. Modus is superb at this. They really drive their clients so to get their accounts done, so the client understands what is my tax, what is the tax I need to pay in 9 months' time. You need to get your accounts to do ASAP. I always say to companies, how much you pay your accountant? £5,000. £5,000. That is 5 days for them. Why does it take them 9 months to do your 5 days work? Get your stuff together because you're on top of your recording of all your accounts data, thanks to Gemma. You can actually now got that ready to give to them and you say, I want this out in 2 weeks' time because it's 5 days work. There's no reason why they can't do that. So be a bit bullish with them. And if they say, oh, it's going to be the end of June, say, well, I'm going to move accountants then because that's just not acceptable. There we are. Thank you, Jenna. Fantastic. We aim for accounts to be filed 2 months after the year end. And that's so here's a thought. You do not need to file your, so just on accounts, you have to file them at Companies House, which is a public record of how you're doing, and you have to file at HMRC. HMRC is all to do with the tax you pay and any tax you get coming back. So you get that filed nice and early, so you know you're on top of the game. You may not want to file into Companies House, because if you're tendering for work through the council and whatnot, they want to look at really healthy accounts. So if you've had a bit of a duff year, delay putting it into Companies House because that's your public record. So and if your accountant, there's a comment here, book that slot in with your accountants. You know, they've got other clients, of course they have, so why don't you book a slot? That would be my view. Okay, questions. I think we've had quite a few questions as we go along, and we're just about on time, so that's not too bad. Any more questions from anybody? I think that's possibly a no for now. Okay, so what we're going to do, we're going to break, and if we can be back at 2:10, that'll be absolutely fabulous. I'm going to go get a glass of water and we'll resume in 10 minutes and I'll go back to the slide presentation. So thank you very much indeed. Speak to you in just a moment. How we doing, folks? Couple more minutes and we'll get cracking once again. And it's me. I'm going to be talking about EIS and SEIS advanced assurance. Edge of your seat stuff, this. So I'll get going in 2 minutes. Okay, folks, we'll get cracking once again. I think it's just about 1:15. So I hope you found that first session really, really interesting. Certainly Jenna's stuff I thought was absolutely terrific. So thank you very much for that. So yeah, keep on top of your numbers. I had one chap, Donald, he says, Sam, I've run my company off the bank account. I said, that's really interesting, Donald. Next time I saw him, he says, I shouldn't just run it off the bank account because I've just had a £20,000 tax bill I hadn't budgeted for. So there you go. So you do need to understand your accounts, your profit and loss, and what your tax liability might be moving forward. As it happened, he managed to get away with it, as in he managed to scratch around underneath the back of the sofa, and he did pay his debt to the HMRC in time. But yeah, keep on top of the numbers, folks. That's a key lesson there. If you are doing some clever techie stuff, do look out for innovation grants. They are a great way of pump priming innovation in your business. Yes, you do need that 4 months cash flow to get them up and running, but ultimately they're a great way of getting free money into the business without losing any equity. And on that note about waiting 4 months for the cash, Robert Rockinghorse in the final session will be talking about that. So yeah, and then R&D tax credits, they thank you for having done R&D. So it's a retrospective pile of cash coming into the business, hopefully. So all in all, hopefully some useful tips for you about how to get cash into your business and looking after the numbers. Okay, so we'll carry on. So I'm going to talk about SEIS and EIS just very, very briefly. I'm only going to do 5 minutes on this. There's loads of information out there. So essentially, these are two schemes for private business angel type investors to put money into your company, and they can then reduce their personal tax bill by having done that. And also, if they keep that shareholding for more than 3 years, and then it's going incredibly well and you sell the company, they don't need to pay capital gains on the money that they might make out of it. So I'll go to that into a bit more detail. Again, do pop questions in the chat. I'll come on to those as I go along. Oops, here we go. I'm going to start on the right-hand side. I've purposely done it the wrong way around to keep you on your toes. So the SEIS scheme, it's the Seed Enterprise Investment Scheme. There are some changes that are coming in at April this year. So for this, you need to be currently under 2 years old if you're doing a deal in the next couple of weeks or have done so in the last few years. And as from the 1st of April, it's going to be 3 years. The company can be old enough. So that's good. So they've extended the amount of the age of your company. You can still access this scheme. And the beauty of that is if you're doing some technology development and you're just bumbling it along, you could soon get to the end of your 3 years before you're actually in a position where you need some proper money coming inside to invest with you. So that's great. He says must be raising no more than 150,000. What that actually means is people who invest under SEIS, it's capped at 150,000 for your business, and one investor is limited at 100k. You can, we did one recently, it was 150k under SEIS one day. The very next day, we got a further investment under the EIS scheme for the balance of what the company wanted. So it's just a cap on one transaction detail. And it's brilliant that they're raising that from 150 to 200,000, because it's just a brilliant way of getting money into the business. You can't be a member of a partnership because certainly bigger companies, they might enter a partnership to deliver a huge project, and it will be a non-limited company because it's a partnership, and 2 limited companies own it. They can each make a claim, but for this scheme, SEIS, you cannot do any of that. You have to be a limited company. Off we go. And they've raised the investor limit, which is absolutely terrific, from 100 to 200k. So that's a great way for, wealthy individuals who love your idea to put some proper money into it. So we've got a question here. Is SEIS available for crypto fintech company that provides debit card facilities? So that's there are restrictions on the types of companies that can actually apply for this, and under the government guidelines there is a list of industry sectors, and I don't know whether banking is one of them. I'm afraid I suspect it would be, so maybe not, but you'd have to check that out, and if you want to contact me afterwards I can point you in the right direction on that question about the crypto fintech company. The EIS scheme is like the big brother. It's generally for slightly larger companies, been around a little bit longer, and they can have £5 million in any 1 year, up to 12 million in their lifetime. So that's quite a bundle of cash coming in. And they actually say if you've got gross assets, that's all your assets added together minus all your liabilities. If that's more than 50 million, this is not applicable to you. You need to go to the private equity market. And they offer SMEs, so below 250 people. They are both really great schemes, and if you're looking for equity, I really would recommend that you should look at these schemes and get something called advanced assurance. Bit of the benefits for both schemes, really. It can speed up investment. If you've got advanced assurance, that basically says HMRC will underpin this tax pack for the investor. That's, people are going to say, well, HMRC have had a look at it. They think it's not a great idea, but it meets the criteria for this scheme. That's great. You can also be a little bit more bullish about how much of the company you're willing to sell for that investment, because they're getting a 30 or 50% discount on what they're investing. So you can use that as a bargaining chip. And in some respects, it differentiates your proposition from somebody who doesn't have advanced assurance. So it does allow you to actually try and get that interest a little bit earlier on. I've got 2 or 3 questions. I'll have a quick look at those. Somebody said I thought they weren't giving advanced assurance anymore. I've not heard that. The last one we put through was in January, and I've not seen anything. It says that they've left EIS as exactly the same. I didn't read anything about advanced assurance. I might be wrong. I will have a look at that, but thank you for pointing that out. I will just check my sources on that. For the investor, of course, they get this tax back when they do their personal tax return at the end of the year. So they are getting it at a discount. So they're absolutely delighted. There's no capital gains to pay for them if they realise the investment after 3 years and get a bundle of cash back. And the third point is under SEIS, if the company goes pop, the investor can secure another 10%, so they can get up to 60% towards their investment if it all goes wrong. So yeah, great schemes, well worth looking out for. An advanced assurance, let's hope it's still around. I thought it was, is a great way of doing that. Here's a quick example. They put in 100 grand. They get their 30% back under EIS, under their private tax bill. They sell it at the end of the day and make 200,000, but they pay no tax on that. So for their 100k investment, they'll come out with 230 grand. And then, yes, the company needs to be a success at the end of it. But for investors, it's a great way to limit their tax that they pay. And hence, it's a great advert for you to get that investment in. Advanced Assurance, there's a bunch of stuff you need to do. This is not a prescriptive list on the right-hand side, but it's a pretty full set. You need a business plan that makes sense. And that needs to show how much money you need, what you're going to spend it on. And so it needs to be capital at risk. It's not just going into the coffers to give you a nice, comfortable bundle of cash that you're never going to touch. So it's got to be for growing the business. And they like to understand that you've actually got some potential investors on board. So let's have a look at your slide deck. A proper cash flow forecast. So P&L, balance sheet, cash flow. I generally do a bit of a tax computation as well as part of that because it fills in the picture. There's a bunch of legal stuff around the company, so memorandums and articles of association, the register of members, current slide shareholdings, all the rest of it. Any accounts if you've been trading for more than a year, and there's in true HMRC form, there are a bunch of forms of theirs to fill in. Generally, they get back within 28 days. If you catch them on a bad day, they'll ask a really innocuous question on day 28 just to allow their clock to reset to another 28 days once you've responded to it. But on the whole, I've actually found them, HMRC, quite good at the advanced assurance piece. We've had no issues whatsoever. So that is all I wanted to say on that. I'm now going to invite Hugo. So I'm going to stop presenting and hand over to Hugo.
Thank you, Sam. I will now try and share my slide deck.
So I'll just introduce Hugo. Hugo is the managing director of a company called River Simple. The vision is to basically do away with the internal combustion engine, not to use batteries with all the accompanying environmental problems with that, but to use hydrogen. And the concept is absolutely brilliant. I've worked with Hugo over probably the last 8 or 10 years, I think, Hugo, all told. And I've seen the car and the company develop, and it's been an absolute pleasure to be part of that journey.
Thank you, Sam. And can you now see my slides?
Yeah.
Very good. Okay. So thank you for inviting me to come and talk to you about this, Sam. We're not a typical proposition, and our funding journey has been quite hard. I'm certainly not suggesting that any of you should do the same as we've done, but we are a fairly special case, and it's been hard for very understandable reasons. But I hope it's interesting, and I hope there's some learning from it. We are building hydrogen cars, as Sam said, but it's important to point out that we're not a hydrogen car company so much as a sustainable car company. We believe we need both batteries and hydrogen. We can decarbonize quicker with both than pursuing one technology. We don't argue, after all, about wind turbines or solar PV, which one's going to win the renewable energy race. They're just different, and we need them both. But nothing can be as sustainable as a hydrogen car for the sort of range to which we've become accustomed. And it's the one area that isn't receiving a great deal or sufficient attention, and the attention it is receiving is much too late, which is why we've got so many battery cars out there. So it's a real opportunity in the marketplace where we could really add some value. I'm going to very quickly set the scenes with explaining the business, because the nature of the business has had a bearing on the funding journey. These are the cars that we're building at the moment and running in trials. We've got half a dozen of them running. They've been in a trial with Pembrokeshire County Council and Milford Haven Port Authority last year. That line up at the bottom right-hand corner is in Milford Haven with the refueler in the port there. And now those cars are all going into trials with retail customers in Monmouthshire. But this car is designed for local use, principally in order to work with our infrastructure providers and develop the hydrogen infrastructure that we need. There's over 3 million cars in the UK that operate locally, and so we're targeting the local vehicle market. But it is only the entry point for the company and the fuel vector into the market. And the technology is very versatile. We can develop all sorts of different cars, and we will be making 5-seat family cars once as the infrastructure emerges. But there are a variety of things that are different beyond the technology. We don't really believe the barriers are technical. They're all to do with people and politics and inertia. And so we're never going to sell a car. We're only ever designing a car to provide under a service contract, vehicle as a service. And customers will typically take a 3-year contract, rather like a 3-year lease, except there's 2 big differences. One is that it covers all your costs. It includes a mileage rate in the monthly direct debit, and it covers not just the maintenance, but all the insurance and particularly the fuel. And furthermore, at the end of the 3-year contract, when the car comes back to us, we don't sell it into the second-hand trade. We provide a second, a third, a fourth-hand customer. We keep it on our balance sheet right through to end of life. And it means that the pricing is based on the lifetime cost, not the build cost. We can bring them to market long before they're as cheap to make as a petrol engine car, but at the same cost of ownership, because the vehicle is amortized over such a long period. And it aligns our interests with those of our customers. Our interests, instead of obsolescence and high running costs, are longevity and low running costs. And it also gives us a direct driver to improve the sustainability of the offering. The more sustainable, the longer lasting, the more efficient, the more resources we capture at end of life and reuse, the more profitable the car is. But there's a number of other things that are different about the business. And as I say, this has a bearing on our funding journey. It's not just the new technology and the new business model, and the 2 are very intertwined. It fundamentally changes the vehicle we build. But we've also got a new manufacturing model, because we're making the car out of composites, and the way in which cars are built today is all shaped around press steel tooling, and that's why plants are 300,000 odd. Ours are only about 5,000 cars per plant per annum, but we'll have multiple plants. But we've also got an unconventional governance model. We are absolutely out and out of a profit company, but we've got a multi-stakeholder governance model where the board's duty is to more than just the investors. And we believe, and some of our investors also have come on board, because we believe it, and they believe it will deliver a more profitable and more resilient business. We're also planning to open source our technology when we come to market. And then finally, of course, we're we've been around for quite a long time as a pre-revenue company. We're over 20 years old. We're a 20-year-old pre-revenue startup, and certainly it is difficult to develop fundamentally new technology in a sector as mature as the auto industry. It is not easy. It's why it's taking so long. And the scale of the existing auto industry is daunting. To imagine that you're taking on the industry. We absolutely don't see it that way. We're complementary to, and we're staying under the radar. But nonetheless, these things are a serious concern. I'm going to really be talking about our story to date, really in the past, more than in the future. I'll come on to the future right at the end briefly. But this is setting the scene of where we are at the moment. We have a holding company with three wholly owned subsidiaries. Only one is the trading company, and one is holding historic intellectual property, and another company is a vessel for all the new IP that we're developing. The cap table is a brief breakdown on the right of where we are. As you can see, there's a very small proportion of the equity is held by financial investors. Most of it is myself and my wife, who set the company up, and a lot of people who've been involved in building the success of the business. We all are now being diluted by investors, and the next round coming up will dilute us more significantly. But I'm going to, although the work of the business is more than just the technology, it's the business models and strategies and the corporate governance. Nonetheless, I'm going to tell the story, defining it around the vehicle programs that we've done, because that's the easiest way to define the different phases of the business's growth. We started off, first real car we built was that Morgan. It's the second car in that image. It was with government support from the Technology Strategy Board, as it was then, now Innovate UK. And it was with two universities, Cranfield and Oxford. It was with Morgan Cars, BOC doing the fueling, and Kinetic doing the fuel cell. But it took 3 years. I'll come back to this. It took 3 years to get the grant to run that program. And whilst we were waiting for and going through that process, BOC asked me to design that Eco Marathon car, which is actually the first fuel cell car we built. The Life car with Morgan was shown at Geneva in 2008, but it never actually ran on its own wheels. It really was a blue sky R&D project. A lot of the assessors thought that it wasn't technically possible. We actually were lucky enough that the chief scientific officer of MARA, the Motor Industry Research Association, vouched for us and said it is theoretically possible. And eventually, after 3 years, we got the money. But that de-risked the proposition, showed it was possible. We then built the Herban, the Hydrogen Urban car, that little black thing the size of a Smart. That was the first car we could drive around, not on a public road. And then we've had 2 generations of cars that are designed for type approval and been running on public roads. And and the company's development really has split into those 2 phases. The first 3 cars, all that fundamental R&D, and then the second phase being the Rasa in 2 different guises, the road cars. And this is breaking down that recent 7 or 8 years of work. Divided into 3 chunks. They actually overlap, of course, but fundamentally the first 3 years was designing and building the first concept car. And that cost us £5.5 million over that period. In automotive, it sounds a lot of money, and it is, but building cars is expensive. And in automotive terms, it's remarkable. It's a lot of bangs for your buck. The second car, that red one, looked very similar, but it was new wheels, new electric motors, new brakes, new chassis, front subframes, front and rear. New cooling system, new fuel cell. I mean, it was a huge redesign, really. And that program was just under 3 million. And then subsequently, we've been building a fleet of cars that have developed from that red car, and these are the ones going into the trials.
You know, Hugo, quick question.
Yeah, sure.
Yeah. How are you? So I've worked in sort of the innovation industry for quite a while, and are fuel cells now fairly robust?
They're not bad. I mean, I wouldn't say they're quite at automotive standards yet, and they're used regularly as a production item in materials handling and forklifts and pallet carriers. I believe that over 30% of food apparently in warehouses in the US is now moved by hydrogen. But of course, it's quite a friendly environment. It doesn't have a lot of potholes to deal with, a lot of variations in temperature. It's all indoors, and they're not as robust as combustion engines are in cars. We have a fuel cell from a forklift. In fact, it's a production item, and it's not fault-free, but we're able to run them with a higher level of service than we would expect from a production unit. They're certainly not robust enough for excavators, which is why JCB have developed hydrogen combustion engines. They absolutely want to get onto fuel cells, but they regard the fuel cell technologies as simply not ready. And of course, there's no more hostile environment than a construction site, so it's not surprising, really.
Yeah. Okay. Thank you for that.
No, nice. So this is now the funding history, and you can see those first 3 proof of concept vehicles above that yellow line, and all the Rasa program below it. I set the company up in 2001. Right at the top of the slide, you can see that there's quite a few different entities. There's been a bit of restructuring along the way. there's been no insolvencies or anything like that, but 2 companies have been closed at one stage in order to optimize our governance model. We had a limited liability partnership, but it became impractical to actually bring outside capital in and to really have the freedom to spend and change your investment plans regularly under in an LLP. A limited company really was absolutely essential. And so the original LLP was closed, and the first company was renamed in 2007 as River Simple Engineering. And that company still exists and is one of the companies holding the IP. In the yellow line is there for 2 reasons, really. And the first reason is that it divides between the concept phases and the production car. The second is that we had a big restructuring. Both before and after that yellow line, in fact, all the way through, all our equity investment has come from private sources, from family offices, and latterly from crowd investment and angels, with a bit of matched funding from government equity providers, in the Future Fund I'll mention later, and the Development Bank of Wales. But it's essentially all private money rather than institutional. Starting off with the early phases, the life car, I essentially was able to be the minority that lead that project, developing the Morgan car, even though there was no employees in the company other than myself. And essentially I paid myself and reinvested the money. And it enabled us to be a partner, draw down some grant funding, and develop really quite a tangible proof of concept for the technology before we ever took on any equity. The Herban was very tightly connected to the Life Car project, that little black car. And I got a grant from a corporate funding body, a grant that's directed at air quality. And for urban air quality, we put together this proposal, got grant funding for that. And I went to an individual who'd invested in an early stage fuel cell company and asked him to match that grant to develop a market for his fuel cells, and which he did. And it was essentially a corporate strategic bit of matched funding. As it happens, he decided that he wanted to invest, and so he actually asked to invest, and that's where the first equity came from. And the company started growing from that. So you can see there's £1 million equity, there's £1 million convertible loan. These are very round numbers, and most of the numbers I've left out. And that led us to the point where we felt we were ready to embark on a design of a production car, but we really struggled to raise funds at that stage. And it was at the time of the crash, just after the crash, it was not a good time to find money. And eventually this individual brought in a family office. It was his extended family, and we secured quite substantial investment. It was a few million. But we were really on the back foot, and we had no other options. And they decided what the pre-money valuation was. So it was not a good deal from our point of view, but it did keep the company going. And it was actually about 25% of what the individual himself had originally been arguing for as a valuation. However, the company got going, but it brought in a lot of people with very different views and ambitions, and they parachuted in an MD from the corporate world, set up a new holding company to run their investment. The MD didn't really understand our very non-standard business, as I was explaining earlier, and different business model, different governance, and so on. And we scaled too fast, and the money was spent not very effectively, quite frankly. everybody agreed it wasn't working, and they actually withdrew from this. They closed the holding company, and it was all very civilized. They sold the whole River Temple Engineering back to me for £1 with a 0 balance sheet. So it really was a fresh start. It was a very nerve-wracking time, and that's when we restructured the business and set up a new holding company and a new trading company.
So
And then
at that stage, Hugo, you were back to 100% ownership then for your pound.
yes, though I did, because it was all the balance sheet was 0. I could give shares to anybody I liked tax-free because they were valueless.
Yeah.
And so I gave shares to all the people who were shareholders in the previous entity in the same proportions that they would have had if the company hadn't been closed and I'd bought it for £1.
Yeah.
And that was mostly a lot of legacy and sweat equity investors. And to the staff, because all the staff stuck with the business through that period, which was quite tense. We really were on a tightrope because we had no money, and I didn't even have title to didn't even own the company when I had to underwrite the future salaries of the staff.
Yeah.
So it was a tense time, and I ended up with about 65% of the business, sort of thing.
Yeah. So it was a lot of this journey has been about relationships, isn't it?
Yes, absolutely.
And just trying to manage. And I think you were saying when the sort of the family office came on board, they were in some respects too powerful for where you were as a company.
Yes, and they certainly didn't understand. They didn't have a common understanding. The original member of the family was fantastic, and I wish he was still a shareholder because he was really good news. But that shared motivation is terribly important, and I've got a few sort of notes I'll come on to. But I think that you've really got to decide on the funding journey, the sort of money you want. Money brings responsibilities and so on, and you've got to find the right money if you're going to build a successful business.
Yeah.
You can't afford your entire. It's difficult building businesses. It's that much more difficult if you've got to spend a vast proportion of your time looking after your investors.
Yeah.
So you've got to have them on side. It's otherwise it really isn't going to succeed.
Got about 5 minutes, Hugo.
Yeah. Okay. Very quickly then. Subsequent rounds have really been crowd investment and some angels. One angel fund came in with that had a relationship with the Development Bank of Wales. So the Development Bank of Wales would match the funding that those angels put into a Welsh business, and so that brought in the Development Bank of Wales as an equity holder. It wasn't that we approached them; it's just that they were brought in on this pre-arranged deal. And I know that the British Business Bank has a lot of deals with arrangements with angel funds. I don't know what the official proper description is, but where they will provide match funding for angels, particularly where it's directed on to clean technology and things like that.
So Lewis is going to say some words on that later, Hugo.
Okay.
Yeah.
And then there was in COVID, the COVID support packages were geared to revenue. As a pre-revenue company, that meant we got nothing. The government realised this and very quickly put together the Future Fund, which again matched convertible loans in convertible loan investments made by private investors, and they would match them and essentially leave the due diligence in the hands of the private investors. But it meant it meant there was a very, very quick mechanism to get some money into the sector. What else should I be saying? It might be surprising we have no venture capital in the company. There's a wide variety of venture capital funds, and a lot of them, no doubt, are, and for a lot of businesses, it really makes sense. But if you think about the traditional hardcore venture capital, it's it's a closed-end fund, and they want to work with the management to maximize value at their point of exit. Our business with our multi-stakeholder governance model is built for the long term, and it's not within our gift to give the level of control to venture capital in order to maximize value in the near term, because that's necessarily at odds with long-term decisions.
And that's entirely due to the vehicle as a service, isn't it?
Well,
Because you want your cars to be lasting 30, 40 years and they remain on your balance sheet.
yes, but they're capitalized, so we get EBITDA positive in our financial model in the second year of production. So it's not so much that, and we don't mind people buying and selling stock, but the decisions about the direction of the business, strategic decisions, we have got protect. I mean, the governance model is designed to protect the purpose of the business and make sure decisions are made in the interest of the long term of the business, rather than being in the hands of short sellers, for instance, in extremis, where
that sounds like the government should adopt the same model then, shouldn't it? Be in it for the long term.
Well,
make long-term decisions for the good of the country. Who would expect that from the government?
I think the concentration of power in the hands of investors with liquid stock markets leads directly to things like Dieselgate and Deepwater Horizon. And actually maintaining a focus on the long term is a much better creates a much better and stronger opportunity for long-term investors, pension funds, family offices, people who are real value creators, want to be partners in the journey of building value in the business. It's no good for day traders. But actually for long-term investors, we think it's a much more, it protects from those sort of disasters that are all about short-term, the attraction of short-term returns. Crowd you've talked about, terribly important. The detailed rules of getting EIS we found very arcane. Knowledge intensive business has been critical to us still being able to get EIS, and we got advance assurance for the round that we're just about to close at the moment. And our experience was very painful of getting it. The first time to get EIS clearance took us over 3 years arguing with HMRC, because it's not available to finance companies. So if we bought cars and leased them to individuals, we would be classed a finance company and not eligible for EIS. Because we're not selling the car, we're selling the service, we were deemed to be a finance company, even though all our money is about R&D and developing vehicles. But it was a very tortuous argument with HMRC, who didn't really want to accept it. R&D tax credits we didn't know about until we had small R&D tax credits of sort of 20 grand a year in the early years, but our accountants really hadn't got their heads around it, and we didn't realize the opportunity we were missing until we met you, Sam. And grants, where I started, they are fantastically valuable, particularly in the early stage. As Sam says, though, you must be careful to get the right sort of grant. You don't want to chase any money and become a grant junkie, because the tail ends up wagging the dog. And if you're going to collaborative partnerships with other companies, you've got to make sure that your interests are aligned. I'd also say never underestimate the amount of work required in preparing a grant application. It is always, however many times you do it, we always underestimate how difficult it's going to be. And I mean, I mentioned earlier that funds come with responsibilities. Do think about working out what sort of money you need when, what you're prepared to take, what responsibility you're prepared to shoulder. When you do take other people's money, as a friend said to me, OPM, other people's money, once you take that, the clock can start ticking, especially with debt, for instance. And I used to be in the motor racing world for years, designing and building racing cars. The one dictum I picked up in motorsport, which we still find very valuable, is the saying that there's never enough time to do the job properly, but there's always enough time to do it twice. And the evidence of that temptation is all around us, I'm afraid. It is terribly important, I believe, to do it properly. And paradoxically, not having enough money gives you the time, not having the pressure to deliver returns, gives you the time to get the fundamentals really, really right, really think through the business. And it also, not having enough money, also develops a very lean culture and a very lean business, which delivers many more bangs for the bucks for investors, which brings us, circles right neatly back to non-diluting funds. I ought to just show this slide. the pie chart on the left is all the money that's gone through the company and our collaborative partners on our projects over the last 20 years, 43 million pounds. The green bits of funds that have gone through those partner companies, and the blue bits have gone through River Simple. And if you look to the right, that pie chart is the funds that have gone through River Simple since 2015, since our restructuring. And of that, you can see that the equity is only 40% of that 12.7 million. If you look at that equity at 12.7 at 5.1 million as a proportion of the 43 million, you see there's actually that's not fair. You should look at the 15 million as a portion of the 43 million. It's nearly 200% on top of that in non-diluting funds that we brought in. So I think that's speaks volumes for the opportunities. And all these things are most important at the beginning. They become less important as you go on, but they're absolutely critical at the beginning. This is the roadmap to the future, why people invest, cumulative funds. And these are the rounds we're looking at in the future. But you're hurrying me up. I think I should probably stop there, Sam. That's it. Thank you very much.
Wow, Hugo, what an amazing whistle-stop tour of the world of River Simple, and your commitment to see this through, I think, is absolutely stunning. 20 years on the journey, and it's now. I bet you're so proud of the fact that you've got a fleet of cars actually out in Monmouthshire, Milford Haven, actually doing what they should be doing.
It's great. It was 15 years till I first drove a River Simple car on the road, and that was quite a big moment, I tell you.
Yeah. And what was your best moment then, Hugo?
God, best moment. Oh dear, oh dear. I mean, it's always the next one. It's the next milestone, really. I mean, the driving the car car on the public road for the first time in 2016 was a big one. Launching the Herban, that little black urban car, in 2009, we had a launch event on the terrace at Somerset House in the middle of London. That was a pretty special event, and we got an awful lot of attention for that. But other than that, it's always the next big thing is much more exciting than the last.
Yeah, and I think what's really come over today is your passion for what you're doing, and in some respects, how brave you've been with sticking to your guns and not being steamrolled. And I think that's a really important lesson for people.
Well, I mean, my wife certainly thinks that having been consistent about things has really added a lot of value and does help build respect. But equally, it is you're absolutely right. It's hard, and there are moments when consistency is interpreted as stubbornness. So it works both ways, Sam.
Yeah. So one quick question. What was the biggest learning point? Your biggest learning point on the financial journey. I'm going to interpret that as, because this is a finance workshop.
Biggest learning.
This is like when you're going for a radio interview and you've got no idea what they're going to throw at you.
The biggest learning is really to try and understand the perspective of the investor. Not something I'm naturally very good at, and I've had to learn. It seems so obvious to me that what we're doing is the right thing to do and is more profitable and everything like that, but it's not necessarily the way other investors see it. And trying to understand why they see it differently is the hardest thing I found.
Yeah.
And the most important thing. Look at it from their perspective. Try and really understand what it is they want out of their investment.
Yeah.
And I mean, it tracks back to the years I was in motorsport, where really understanding what a sponsor wants to get out of it. Sponsorship can be all sorts of things you can get out of it, internal corporate things or external messaging or whatever it may be. There's lots or client entertainment. There's a vast array of things, and really understanding what they want out of it is the key to building a satisfactory relationship, and having a good relationship with your investors, I think, is absolutely
Yeah.
critical if the company is going to be a
Yeah.
success, and you're going to have the
Yeah.
bandwidth to focus on the
Yeah.
business rather than on the investors.
And fantastic. And one last question: have you walked away from an investor who put money on the table because you realised that it would push you down the wrong track?
Yes. The biggest one being a joint venture in a country on the other side of the world that we needn't mention. I mean, eye-watering money.
But it didn't fit with who you are and
Well,
what you wanted the company to be
Well,
like.
it would have taken us over, and it would have been, I mean, it would have been money, but it would there was no shared motivation at all there. It was all about trying to get money of public sector grants that were available, claw them down as quickly as possible. No interest in the sustainability.
Yeah.
No interest in building long-term value. And it really would have been a sacrifice of everything we'd built up.
Yeah. And that's a very brave decision to make, isn't it? Because
It didn't seem difficult at the time.
good. Hugo, thank you very much for your honesty and showing us the passion that you have and sharing with us your journey. It's been absolutely fascinating. If you can stay around for the panel session at the end, that would be absolutely fabulous.
Certainly.
Okay, everybody, we're just going to break now. I'd like us all back in, if we can, for 3:05. So just a 5-minute break, really. And then we're actually only going to be 5 minutes behind the curve, which isn't bad, really. So yeah, 3:05, please, and then we'll continue. Thank you very much indeed, everybody. And thank you, Hugo. Absolutely terrific. Hello there, everybody. Back again for the final session. We've just got there's a bit of a long. Thank you. I've just been reminded I've been talking to myself with a wonderfully muted microphone. 3 years down the line, I'm still making mistakes. Anyway, I hope you've all enjoyed it so far. I'd like to thank Jenna and Hugo for their talk so far. And yeah, fantastic. Awfully illuminating as to the journeys that certainly Hugo's been through. Welcome back from the break. I'm going to move on to Shakespeare's talk now. We've got Roger covering off some of the legals around money and finance. So, Roger, are you ready to rock and roll?
I am, Sam. Thank you.
Right. Okay, I'm going to hand over to you. I'll stay in the background and shout at you as and when needed, really.
Okay, thank you. Hello, everyone. Lovely to be presenting to you today. And can I just add my thanks to Hugo for sharing a really inspiring story, and grateful for your insights and honesty. So, I'm being assisted by the lovely Joe today, who's controlling the slide. So thank you, Joe. So I'm going to do my best Chris Whitty impression and say next slide, please. Thank you. So just a very quick overview as to what the guys have asked me to cover today. A little bit around legal issues for funding and financing, and also a sort of broader question of legal considerations when growing a business. So actually there's an awful lot to go out there, and this is a very high level review. Please feel free to ask questions either now or at a later date if there are particular issues that I cover where you need a little bit more information. And I'm conscious that we've got quite a broad church here today. So for some of you, this will probably be teaching to suck eggs, for which apologies. For others, this might be a little further down the track from where you are in your journey, but hopefully will be of some use. So next slide, please, Joe. So top tips for legal considerations generally when growing a business. I think number one would be start at the end of your journey. Where do you want to get to, and work back, and then in terms of that process, fit in the legal bits and pieces into that journey, because as Jenna was saying, you really need to have some understanding of where you want to get to in order to make sure that you've got the right pieces of the jigsaw being put into place along the way. And there's no point starting off with something from a legal perspective which isn't going to be fit for purpose when your purpose is, well, you know what your purpose is, you know where you want to get to, but you haven't really considered the end goal when implementing legal structures to start off with. The next point I would say, just generally think about your assets. You know, what are your assets? Is that your sort of physical bits of kit, or is it actually intellectual property and know-how, or is it your people? And really sort of focus your legal strategy and spend around those key things. And also on the same note, think about the key risks in your business model. So to your entity, to your model, to your business, to your people, to your assets, and again, focus your legal spend on those things, and don't necessarily get distracted and over-engineer. I think that law and the application of law to your business is really about two things fundamentally. It's about compliance with the regime in which you are operating, of course, but really it's about sort of ethics, and it's about economics. And I tend to focus on the economic bit in what I do, which is helping people to buy, sell, and build companies. What I mean by that is that whenever you're looking at risk and reward in terms of the legal applications to your business, you need to do a cost benefit analysis. You can have a contract which can try to cover every eventuality, for example, but it would be hugely expensive to implement that contract. So really, going back to the first couple of points there that I made, protecting your assets and focusing on the key risks, when you're looking at your legals, I would urge you to spend money on those key risks, to spend money protecting those key assets, but again, and not to be distracted into over engineering where you don't need to. So always do that cost benefit analysis. Next point would be build relationships. So build a relationship with your accountant, build a relationship with a lawyer. If you've got that relationship, the sort of relationship where you can pick up the phone, just ask for a bit of off-the-cuff advice, that's very valuable and might allow you to sort of head you off at the pass if you're going down a bit of a rabbit hole or a dead end. And generally speaking, like Jenna was saying, you know, don't put off to tomorrow what you should be doing today. That really applies to your sort of legal frameworks as well. Get the frameworks in place in the right way early in your journey, and that de-risks things later down the track when you're probably talking about more value being at stake. So next slide, please, Joe. So what are the key legal risks? Well, obviously there's the compliance risk. So depending on the sector that you're operating in, that could be more or less onerous. I'm not going to talk about that today because it's very sector specific. Generally, there are risks around ownership. So who owns what and what they can do with it. Governance.
So Roger, so the point there on compliance is, you know, if you're in the building trades, it's health and safety, working at height, the legislation around that you need to comply with. Do you remember that? If it's selling a medical device product, it's looking at CE marking, looking at ISO 13485, it's blah, blah, blah. It's exactly being aware of the legal requirements for your particular business type and the product that or service that you're selling.
That's absolutely right. Yeah. Okay. Yeah. And that's going to be different depending on what sector you're in. And obviously, you know, it's something that you need to be understanding. You need to be immersed in that for your particular sector, but we don't really have the time or scope to go into that now. So the third point there is governance, by which I mean the structures that you've got in place for decision making and around share ownership and the control of that, which I will be talking about moving along in the presentation. The next key legal risk is around trading. So who you're trading with, your customers, your suppliers, and contracting around those relationships. One of the future workshops, I think, will delve into that in a little bit more detail. Employees is a key risk for most businesses. Generally, you know, you will have employees. You might not have many, but for every employee is a potential headache and a risk. So you really need to make sure that you are complying with employment legislation and properly contracting with employees. But again, we've got another workshop that will deal with that in a lot more detail.
I was always told in business, you don't want staff, you don't want suppliers, and you don't want customers.
If you could do away with all of that,
you could do away with those three, it'd be like
perfect model.
Easy. Yeah,
absolutely. Yeah. So one of the key assets for a lot of businesses increasingly is their intellectual property, and we have a workshop on that. I can't remember exactly when it is, but one of my colleagues will be delving into intellectual property in a lot more detail. So next slide, please, Joe.
On the intellectual property side, I'm sure as the Patents Office used to have a little bit of funding, they may still have it, like £3,000-4,000, where you could pay somebody to come and do an IP audit on your business. So it wasn't just the regular patent, trademark, design right. It went into things like how well defined is your processes, because that's a piece of IP in the business. You know, what's your new product introduction process and how quickly can you do that? So if you're doing that for a customer, so you make money, and they could be quite, you know, the intellectual property isn't just the obvious stuff. There's an
absolutely right. Yeah, people think of intellectual property as a patent, but actually it's much broader than that. For most people, it's more around know-how than something that is necessarily registrable. I know Ed's going to cover that. Ed, my colleague Ed Wright, will cover that in detail in a future workshop. So I won't delve into that now, but you're absolutely right. The intellectual property asset can be really varied. So a couple of things that I did want to cover, ownership and governance. So share ownership is absolutely key. Most businesses will incorporate as a company limited by shares. There are other models, as Jenna mentioned, but this is absolutely the standard model. So it's really important to understand share ownership structures. Two key things that impact on share ownership structures and also the governance model for your company. So by governance, again, I mean sort of decision making, really, who can do what and when and how, are shareholders agreement And don't get confused by terminology. You know, sometimes they're called founders agreements, sometimes they're called subscription agreements. If you've got investors, it will be called an investment agreement, but it's all the same thing. It's a contract which talks about the relationship of the various shareholders with each other and between the shareholders and the company. The Articles of Association is a similar document in some ways. It's a sort of management handbook, but it's a publicly available document. Every company has to have Articles of Association. It is a contract between the shareholders and the company, but it's one of public record, whereas a shareholders agreement is a private contract. And the third element of the ownership and governance sort of triangle is the Companies Act. So I tend to find that a lot of clients don't really have much knowledge of the Companies Act, which is concerning because every director of the company is subject to quite a large range of obligations and statutory duties under the Companies Act. And if you're not acting in accordance with those, then there is potential personal liability.
Is there a very obvious place you can like get a snapshot of directors' responsibilities?
Yeah, there's loads of stuff on the
there must
internet,
be.
Sam. Yeah,
Yeah.
loads of summaries. Next slide, please, Joe. So shareholders agreements, very quickly, if you haven't got a shareholders agreement, I would encourage you to have one if you have fellow shareholders, and get one before you start falling out as well, because it's there almost like an insurance policy. Once you've got one, you probably put it in a drawer, hopefully forget about it and never need to use it in anger, but at least it's there just in case. So the 5 things that shareholders agreement really need to cover: rules around share ownership, so who can do what with their shares, when and how. If you don't have any restrictions on that, and you have incorporated your company with what are called the standard form or model articles, there are no restrictions on share transfers. So you could be in business one day with your partner Sally, and the next day Sally could have sold the shares to Joe, and you've got a new business partner. You've got no ability to restrict that. So it's really important in your shareholders agreement to control who can do what with their shares, when and how. The next area that the shareholders agreement must deal with is decision making. So you could have a company, for example, with 2 shareholders, both of whom have 50% of the shares each. If they can't come to a decision between themselves, where do you go? You're absolutely deadlocked. And you need a mechanism in a contract to help you through that deadlock. If you have a majority shareholder and a minority shareholder, you may well say that certain things can't be done without the consent of the majority shareholder, or indeed flip that around: certain things can't be done without the consent of the minority shareholders, because they may have put time, effort and money into the business and want some say over the company. The thing to bear in mind about decision making in companies is it's a case of majority rules. So if you've got a majority of the shares, you control the company absolutely, and by majority it's anything over 50%. There's very little that you can't do if you've got a simple majority, including controlling the board. And just to take it back to basics, just so that because a lot of people who own companies are also the directors, so this gets sort of merged and muddled into sort of grey, but actually there's a separation between ownership and management. What the basic company constitution says is we're devolving and delegating the management to the directors. So it's not the shareholders that make the decisions, it's the directors that make the decisions. But if you control a majority of the shares, you also control the board, because you can hire and fire as you see fit. So the 2 things do come together, but they are different. The next thing is restrictions. Next slide, please, Joe. I think I've probably actually, next slide. I've skipped through a few of these. Next slide. So restrictions. So restrictions are really around protecting the business. So making sure that a shareholder can't on day one get under the skin of your business and then leave the business on day 2 and set up in competition. So a classic restriction would be you can't compete against the business, actually, either whilst you're a shareholder or after you've ceased to be a shareholder. But you'd also tend to build in what we call a non-poaching clause, which is you can't steal our staff either. Now, a lot of people, I think, are under the misapprehension that restrictive covenants in contracts are not enforceable. So some people sign up to restrictive covenants thinking, well, this is never going to be used against me, it can't be enforced against me, but that's actually not the case at all. They are very definitely enforceable, provided they're drafted appropriately. If, generally speaking, they are reasonable in the context of protecting the business's interests, then they will be enforced. So, for
And
example,
how does that compare with people's right to work? So I don't know, you set up a company to design and manufacture a knitting machine, and you set it up with somebody else, and then you fall out with them, and all you've ever done is design and manufacture knitting machines. Would it be enforced, and there's a non-compete? Would they be able to go and that? But that's all they know about. They've only ever made their money by designing and making knitting machines. Is there a conflict there between a person's right to earn money and non-competing with it?
It's a really good question, and the answer is yes, there is. And basically, our law starts from the perspective of saying, well, we don't like anti-competitive behaviour. We like to have a free market, and part of that is allowing people to work. However, the courts do recognise that in certain circumstances it is appropriate and reasonable to allow restrictions to be enforced, because that actually facilitates trade and investment. And a shareholders agreement is one context where they will allow that, but effectively a court will always look at what's the value transfer. So what is the restricted person getting out of this? You know, have they had value in return for the benefit of the company having this restriction? And if the answer is no, then the restriction might not be enforceable. But if the answer is yes, and it's reasonable to enforce, and the period of enforcement or restriction rather, and the scope of the restriction is reasonable in the context of the business itself, then it will be an enforceable restriction.
Yeah.
Next slide, please, Joe. So also, one of the things that you really need to cover is intellectual property rights and confidentiality generally. So there's a common mistake that's made with early stage businesses. Intellectual property is often created by the founders in advance of the company being set up, and they're never actually assigned into the company. So I had a number of situations where we've been selling a company and somebody said, well, does the company actually own this intellectual property? And the answer has been no. In fact, I've had a situation where we sold a company, and then after the event, the buyer realized that part of the intellectual property asset, which is quite a valuable part, wasn't actually vested in the company at all. So we then sold that as well. But this can be the case with founder IP, or it could be the case with employee IP, or indeed if a consultant's been engaged to produce IP on behalf of the company. Now, a common mistake, actually, just on that a lot of people make is they assume that where a consultant has been engaged to help produce IP, then the intellectual property will automatically belong to the engaging company, and actually the reverse is true. So unless you have a contract with that consultant which says we own the product of the assistance that you've given us, then the consultant can lay claim to that intellectual property. So but that's a common pitfall that a lot of people fall into. With employees, the presumption is the reverse. So if the intellectual property is being created by the employee whilst working for you, then the presumption is that that intellectual property does belong to you as the employer. Domain names are commonly left outside the business as well. So what you want in your shareholders agreement is basically an acknowledgement that anything that's produced in connection with the business is owned by the company. Trade secrets are not necessarily something that you can clearly articulate. You know, it, like you were talking about, Sam, you know, patents, that's obviously a bit of intellectual property. Trade secrets can be just as important, which is why in your shareholders agreement you must have a confidentiality clause which restricts people's ability to talk about that intellectual property asset of the company. And that's really important where you've got shareholders coming and going, for example. So you don't want a shareholder who has been party to very important confidential information and confidential conversations to be able to go off and leave the company and then use that confidential information, or even just sort of display the company's dirty laundry in public. Next clause, slide even, please, Joe. Thank you. A super important area for shareholders agreements is dispute resolution. As I mentioned, you might have, for example, a situation where you've got a 50-50 company, so neither shareholder has the ability to outvote the other, which can lead to an impasse. Equally, you might have a governance matrix which says, well, you can't do certain things without the consent of an approved majority, or even without unanimous consent. So what do you do if you don't achieve that majority, or you don't achieve consensus? Ultimately, there's not much in the Companies Act that can help you out of that situation. In fact, there's nothing really, unless one party's been abusing its power. So you need a contractual solution, because the only alternative then would be to go to court. And the cost of going to court, both in terms of pounds and pence, but also stress, frankly, and delay, is just eye-watering. I haven't looked at this for quite a long time. Fortunately, I don't come across it that frequently, but I did about 10 years ago research the cost of getting to court, and on average it was about £300,000 to have your day in court.
Wow.
And when you get there, of course, it's a bit of a lottery, and you could end up losing, even if you think you've got a strong case, and then end up having to pay somebody else's costs as well. So it's really
Can you
astronomical.
nominate ACAS as a route to dispute resolution?
ACAS is really in the employment context, as
That's
far as I
that's
know.
employment, is it? Anyway,
Yeah,
okay.
yeah. But you would typically go to mediation before getting to court, which is hopefully a solution to the problem. But mediation isn't an imposed solution where court imposes a decision. A mediator just tries to get the parties to agree, but can't force them to. So we need a contractual mechanism to avoid all of that, and as a deterrent. And what we typically use is something called Russian roulette, which is a kind of funky name for something which is quite prosaic. Basically, it's just a way of ensuring that one party can move forward and buy out the other party. But it's necessary to have it there, if nothing else, as a deterrent. Next slide, please.
So someone's asked a question, Roger. Is 76% absolute control?
Well, not 75% is absolute control, in the sense that there are some things that require what's called a special resolution. So that's shareholders holding shares equivalent to 75% of all shares. So things like changing the articles, changing rights attaching to certain classes of share, they all require a special resolution. But the reality is that you can pretty much do anything you want to with a simple majority, so more than 50%.
Okay, lovely.
Just wanted to touch very quickly on non-exec directors or consultants and giving them equity and options, because in terms of share ownership, this is something that we come across a lot. A lot of people have given away equity to advisors, non-exec directors, and repented it later. Next slide, please, Joe. So when you are engaging advisors, call them consultants, or non-exec directors, you just have to be quite clear about the scope of their engagement, and being clear about what you want and need from them, especially in the early days when you might have a lot of people that talk to you professing to have a little bit of knowledge, and you engage with them and you bring them on board and you give them shares, and actually they don't really add a lot of value. So be really clear with people what you need from them. Take references if you need to. Just a very quick point on the difference between executive and non-executive directors, because this is a common cause of confusion. They are both directors. So a director is a statutory officer of the company, someone who's registered at Companies House as being a director, and a director has the ability to commit the company to liability. So they can enter into contracts on behalf of the company, and the company will be bound by them. But non-exec directors and exec directors are both directors. The difference is an executive director is an employee, whereas a non-executive director is not an employee. That's the only difference. It's an employment law distinction, not a company law distinction. So be very clear about what they're supposed to be doing for you. Make sure that you have a clause in a contract with them that says any intellectual property that's created is the company's. Make sure that they're bound by confidentiality. Try to restrict them from being involved with competing companies where they could either deliberately or inadvertently disclose important information. If they're consulting with you, make sure that they've got insurance. Make sure that the termination provisions are really clear. Make sure that you're really clear about what you're paying them and when. Is it payment by results, or is it just like a retainer? And whether or not you give them equity, I would always counsel anyone not to give away equity unless they absolutely need to. Sometimes it's a really powerful incentive. Sometimes it's appropriate. Sometimes it aligns people, but a lot of the time it doesn't. And it might not even be what people are looking for. But certainly, if you are considering giving equity away, I would say attach some conditions to it and do it by way of giving an option, which is a right in the future, subject maybe to some conditions being satisfied, to acquire shares. So you say, well, you can have shares if you do A, B, and C. But if you don't do A, B, and C, you can't get the shares. Next slide, please, Joe. So I would always say go for options rather than just giving shares away, because at least it builds in that delivery of value. Very quickly, a common share option scheme is the EMI scheme. We don't really have time to go into that now, but for employees, it's a really good scheme and it's got some great tax incentives. Generally speaking, where you've got options, as I say, build in some vesting conditions. So ensure that you are driving the behavior of the individual to whom you're granting options in the way that you want to drive it. So if they're a salesperson, sales targets; if they're a product development person, milestones and product development, etc., etc. Next slide, please, Joe.
So we've got about just about 5 minutes, Rog.
Okay, I'm going to whiz through this then. So specifically in relation to equity funding then, next slide, please, Joe. So Hugo's brilliantly described the equity journey for him. This is the classic equity journey for a lot of early stage businesses. So pre-seed, friends, family, and some people unkindly say fools, then on to seed capital. So that's again friends and family or business angels who are angel investors, individual investors who typically would want to get involved in the business. Series A for a developing company with a product but going to market, and Series B developing your market. And generally speaking, not generally speaking, but I absolutely agree with Hugo. It's not just about the money, it's about the investor. If you have the luxury of being able to choose between investors, always go for the one that you think you can work with, because you'll have some bumps along the road. And when you hit a bump, you really want your investor to be on your side. It's hugely important, that relational aspect of being invested.
It also pays that if you're going to the market for equity of some description, then to try and have people compete to be able to invest in you, because then you can drive out a better deal on the back of that.
Absolutely, get a better valuation. Yeah, for sure. Next slide, please, Joe. So in terms of like a classic seed or Series A investment, you'd have a term sheet to start with, and then I wanted to touch on a couple of other aspects which you would potentially find in an existing shareholders agreement, but you would certainly find in an investment agreement. Next slide, please, Joe. So a term sheet is what you would get from an investor setting out the principles of their investment. So what they're investing for how many shares, and what are the general things that they want to see incorporated into the company's constitution. They're non-binding, which is a really important point. You will also have covered in a term sheet that the fees that an investor will typically charge. So for a VC or private equity, they'll be looking at a one-off fee, which could be between 1% and 3%, and then they'll typically charge an annual fee, which they'll call a monitoring fee or an investor director fee. Next slide, please, Joe. So just around governance, very quickly, there will be more governance when investors invest in you. Some people see that as a bad thing and tying people's hands, but actually I see it as a glass half full thing, because these are good habits to get into. So you'll have a more rigorous board structure, a more rigorous decision-making process, and you'll be producing and required to produce more information more frequently. But again, all of these things are useful business tools. So it can feel like it's a negative thing, but it is actually a positive thing.
And where do you stand with, you go to the market for your Series A or seed round, and you've got a bunch of business angels interested, and then you go to a Midven or a Minerva who come along with a matching fund. Is it good to have, just trying to corral all these people who've suddenly invested and reporting to them and getting them to agree with a course of action, are you better off going single source for your money, or spread it out? But then I don't know. Have you got any thoughts on that?
I have got a lot of thoughts on it, and it's quite a complex answer. I mean, fundamentally, you want as few fetters on your discretion to run your business in the way you want to run it as possible. The reality is that there will be some restrictions when you bring in investors. If you're bringing in multiple investors, then the important thing is to ensure that no one of them can stand in the way. So you wouldn't want a 5% investor derailing a project that everybody else agrees with. So you've got to have a mechanism which says, okay, well, we accept that there needs to be some fetter on our autonomy. But maybe only if all of you investors agree that we can't do something, then we're stopped from doing it.
Yeah.
It's a really complex dynamic in the negotiation, but it's a really good question.
Yeah.
Next slide, please, Joe. So, which is actually about what we're covering here. So, consent matters, so these are all things where an investor will say, well, you can't do these things without our prior consent. So it's exactly what you're just asking about. The key thing here as well is to try to make sure that although you probably have to accept that the investor does have the right to say, well, you can't do X, Y, and Z without our prior consent, try to get them to agree that they can only exercise that veto in a reasonable way. It's absolutely key, because if you can point to their behavior and say, well, it's not reasonable for you to object to that, then that puts you in a much stronger position than a simple we can say no.
Yeah.
Next slide, please, Joe. So the other aspect of the difference with investors is they'll ask you for warranty. So these are contractual statements about what the business is doing, what the business has done, and also you'll be asked for forecasts. So you'll be asked to stand behind those forecasts, not to say that they will come to pass, but to say that they're reasonable and you've done your homework. So the whole conversation around what warranties you'd be giving, the ability of the investor to make a claim against you if you've given a warranty which is wrong, it comes into the mix. So there's quite a lot of time spent on this, and it's quite a detailed area again. But just to flag it up, that is part of the investment process. Next slide, please, Joe. The other part, which is a very vexed issue, is investors will typically say, look, we're not just investing in the company, we're investing in you, the management team, the founder team. So we want you to be there with us, shoulder to shoulder for our journey. What happens if you leave? An investor will typically want a sanction. They'll want to get your shares back from you in some way, shape, or form, which we call a leaver provision. And leaver provisions can be really basic and brutal, or they can be quite nuanced. But effectively, this is like handcuffs to the business, and all investors will want it.
And then there's good leaver, bad leaver aspects as well.
Yeah. So if you die, you're a good leaver. If you walk off in a fit of pique, or you've been naughty, you're a bad leaver. And the way the mechanism works will be different in each scenario. Next slide, please, Joe. I won't cover SEIS. You've covered it already, Sam, but it will be a factor in the documentation for the investor. So, for example, they will restrict you from selling for 3 years because they won't want to lose their EIS relief. So very quickly on debt funding documentation. Next slide, Joe. So you can have various types of debt, and I think that Lewis will be talking about some of them later. You can obviously have a straightforward loan, in which case you will have a loan facility agreement, or you might have a hybrid product like a convertible loan, which is an amount of money which comes into the business as a loan and could be repayable as a loan, or it could in fact convert into shares depending on the circumstances. Sometimes that is at the option of the company, sometimes it's at the option of the lender. And typically speaking, the key things to look out for, I would say, in terms of debt funding documentation are making sure that you properly understand the difference between the amortization profile and the repayment profile. So a lot of lenders will say, well, we'll give you 25-year money. But what they actually mean is we'll look at the repayment structure as if it were a 25-year loan, but actually we'll only commit the money for 5 years. So at the end of the 5th year, you're going to have to repay everything. In the meantime, you've been paying it off as if it were a 25-year loan.
Okay. Yeah.
But actually you have to refinance at the end of the 5th year. So a lot of people fall into the trap of thinking, well, I've got this money for 25 years, when actually they have to repay the whole thing in 5 years and then go through the whole process and incur the fee again at the end of that period. Make sure also that your forecasting, your financial forecastings are showing that you can comply with the covenants of the lender. So a covenant will be something like, we have to make sure that your business cash flow covers the debt repayments and the interest payments by a factor of 1.5 to 1.
So we had an interesting one there. We were doing an R&D tax claim for somebody, and they had covenants with the bank for bank loans to do some of the R&D and to build out some of the kit, and he had an option to get a bigger R&D tax claim by restating his accounts, which would have taken some stuff out of capital and put it back into the P&L. But then he says, I'm not going to do that in case it upsets the bank and I'm now in breach of their covenants. I'm probably not going to be, but the fact that I've done it and actually the company is better off cash wise, he was worried about what the bank would do. So you really have to watch out for those covenants and get them pinned down and agreed and going with your eyes wide open. What happens if?
You do, and you absolutely have to test them, because the bank hasn't necessarily applied its corporate brain to setting the covenants. And sometimes if you look at the covenant in the context of the borrower's financial model, they're just being set up to fail, because the covenant doesn't work in the context of their model. So you really need to either to understand it yourself or work with your accountant to make sure that you understand it and that you will be compliant with a little bit of headroom to spare. The key thing I would say, though, is the relational contracting side of things with your bank manager, if you've got one, because as long as they feel like they're understanding what's happening in the business, even if you're going through some difficult times, they'll be much more supportive. What they really hate is surprises.
Yeah.
So you never really actually want to be close to sort of sending them a set of accounts where you've breached your covenant, and this is the first time they hear about it. I think I've run out of time, haven't I?
I think you have.
Yeah.
No, but that's your last slide anyway, I think, Roger.
It is.
Hey, there we go. Roger, that's been an absolutely fascinating whistle-stop tour around just some of the legals people need to be considering as they go through any stage of your business life, isn't it? It can be when you start up, it could be when you're getting equity, going down the debt route, and just those hints and tips will hopefully just make people think, I need some help on this just to get it absolutely right and to protect myself. And it's very easy to think I can do this all myself, and then it can go very wrong. So thank you very much indeed for that. Getting a load of thank yous coming through as well. So you obviously did a great job there, Roger. So thank you very much. And of course, Shakespeare is our headline sponsor. So thank you very much for all your help moving forward. Okay, thank you for that. Rocking Horse Group. We've got James and Rob. This is really great stuff these guys do. We've only known these guys for maybe 6 months, but Hugo is certainly used the services of Rocking Horse and has been absolutely delighted with them. And it's a really quite a unique offering and extremely useful for sort of fast growing, innovative companies that are looking to access R&D tax credits and grants. So Rob, if you want to share your screen and get underway, that'd be fabulous.
Yes, just bear with me. Good afternoon, ladies and gentlemen. Whilst I'm capturing our screen, just bear with us.
So I got about 15 minutes, yeah, Rob?
Yep, absolutely. Okay, hopefully everybody can see that.
Yep.
Clear, perfect. Yes, good afternoon, ladies and gentlemen. And firstly, Sam, thank you very much to you and Team TBAT for asking us to present this afternoon. I'm Rob Fabro, my colleague James Davis. We would like to introduce you to our product and our solution. We are an advanced funder in the R&D tax credit, and I'll call it broadly gov.uk, or also which Innovate UK is part of, Grant Space, which enables SMEs to access non-dilutive working capital to invest and accelerate their growth. Sorry, driving the slides. Bear with me, and excuse James's cold, ladies and gentlemen.
That's why they're not sitting so close together, isn't it?
We are trying to stay a little bit away from each other, so apologies for that. So we, as said, provide advance funding against those claims for R&D that Sam talked to earlier, and also, as I said, the grant piece that Sam also mentioned before. We are able to provide the funding from smaller amounts, around 50,000, up to in the millions, depending on the size of the grant and or the claim that is coming back. Just quickly, Rocking Horse, we started originally in Australia as an Australian business. The tax regimes between here and Australia are effectively identical. The business was brought here to the UK in 2018. James and one of our other colleagues set the business up here in 2018. So we've been running, this is our 5th year in the business here in the UK. We are purely a debt provider, so we rely on the good people like those that have already presented, who do the R&D tax claims, who do the accounting work, or alternately who write the grants to get access to the government funding. Our solution is that we offer a debt solution. We're an SME ourselves, and we fully understand the challenges of managing your cash flow and your working capital.
I think the other thing just to mention is we are obsessed with partnership. So as Hugo and Roger mentioned earlier, it is about the investor on the equity side. On the debt side, it is about the client and servicing that client and partnering with them. So that's very much something we want to continue to drive, and that's our really key mission, to partner with businesses and to help accelerate that innovation.
So as I mentioned at the start, purely as a lender, we are not in a position whereby we are asking for debt and we are diluting your shareholding, I should say, as an entrepreneur and an innovator who has set up a business. So we don't have any claim on the future profitability of the business. Ours is purely and simply a debt facility where there is interest and principal amount, and it helps you control and own your business.
I think the other thing is, Roger mentioned, is some of the covenants, queries, questions when it comes to debt can be confusing. We're very much on the side of the client. For example, interest is paid upon repayment from HMRC. We don't require monthly interests. The actual loan is for working capital and to help the business accelerate. So we completely understand, as Rob said, we are an SME ourselves, of that relative flexibility, much more pragmatic than the traditional lender, the banks, etc. out there.
So our solution is quite straightforward. It allows you either on your R&D or your grant to basically draw down through the course of the year. Importantly, for an R&D claim where someone like Sam has produced the documentation for you, is submitting, it's of course for the qualifying component that is R&D spend, and we rely on Sam and others to actually give us that data. We don't provide that, as said earlier, we're purely a debt provider, but it allows you the opportunity then to be able to draw down. We can lend before, at, or after year end. So very key point, as has already been discussed in this forum that Sam mentioned before, where there are some changes that are going on with HMRC lowering the refund level. We've been able to lend to companies running up to the end of the fiscal year, which is nearly, of course, upon us, and when the changes will take effect. But we can lend to you on a pro rata basis before your year end, at your year end, or after.
I think the other thing to mention is companies do question if they fall into the mandate of borrowing or advance funding against their R&D tax credit or grant. The only businesses which do not want to borrow and should not borrow is when things, revenue, costs are all flat. When businesses are accelerating quickly, or if there's change in the economy, whether it's due to COVID, whether it's to do with Brexit, recent global events, that is when we can get involved. Example, when a business is able to sign up a strong agreement and it turns from a 2-week to monthly payment to a quarterly payment, these types of cash flow pinches is where we can help a business. So there's an example where the acceleration is growing, things are going very well, the growth is much more than expected, but yet there is still a cash flow headache, and that's where we can help and get involved with that working capital.
So one of the questions just popped up is, so you're quite different to invoice discounting, which is ownership of your debtor book, and they release it, a certain amount of that, as you invoice staff, and then if you don't pay it back in 3 months, they can claw back what they lent you. Yours is nothing like that at all, is it?
No, nothing like that. What the best way to describe exactly what we do, we recognize that tax credit before payment is an asset, and that asset is what we're lending against. And so that could be in month 9, it could be at year end, or it could be after year end and waiting for HMRC to pay it. We can recognize it, and hence we can lend against it. So that's where we view it. It is also, so it's arguably asset backed. The second thing is it's bridging finance. So we have great examples where businesses are, as I said, accelerating quickly, growing quickly. There are pinch points in those cash flows of the business. That's where they can recognize that asset, obtain the money, continue to grow, when others, banks, other potential lenders just do not recognize it at all.
Yeah.
So on that point, that's exactly one of the key challenges our clients face, is at that earlier stage of their evolution, they find it very hard to get the financing. So as Hugo talked to before, and his journey in terms of raising money, and whether you want some investors or you don't want some investors, the problem is that a lot of the normal people you would go to, banks, will not lend at the stage that we are at. So some of our clients are pre-revenue. They're loss-making, obviously, from a point of view of being able to claim back the tax credit from HMRC. But it's key in terms of there is the ordinary normal banks don't and won't help you, unfortunately, at this stage.
Okay.
Our process is relatively straightforward. We do everything from start to finish internally. As said earlier, we've worked with good people like Hugo before, who will hopefully attest to the speed and the agility with which we can move. The process is a detailed DD, due diligence with our credit team, and I'm going to shorten the length of all this in the interest of time, but it's discussion with one of our team, James, myself and other colleagues. It is then a DD which is undertaken by our credit team. A recommendation goes to our credit committee, and let's assume, because not all of them, I hasten to add, but let's assume the loan is approved, and we're looking primarily against the cash flows of the business, the borrowing business. We can then extend up to 80% of the refund or alternately the grant, and it's the government component of the grant. So as was touched on before, if a grant is 500, of which the government's giving you 400, and you as the company have to fund the 100, we can help out against the 400 component. We help out for duration. Our loans are 6 months. So if it's a grant, and the grant runs, most of them are 1 year or 2 years, we will have a facility in place for 6 months, which at the end of Q1 and again at the end of Q2, after we perform a health check, if everything is fine, we can extend the loan over that period. It's also very important to note, because we come across this with when we're lending to some folk, it is secured lending. So we will lodge a debenture, a charge against the assets of the business for the duration of the loan.
I think what you've got on that slide is quite interesting about the 80% of the value minus only statutory there. A lot of people, well, not a lot of people, we've done R&D tax claims and they said, well, where's my money? And we said, well, you never told us you owed HMRC 6 months pay as you earn and the corporation tax from last year. Oh, well, yeah, well, that's something else, isn't it? Well, HMRC have got the capacity to offset one against the other and reduce what you get at the end of the day. So that's protecting you by saying HMRC is owed money from this company. The R&D tax will be offset against it. We'll lend against the balance that you should get in your hands.
Exactly, Sam. And I think PAYE deficit is one of the key things that companies experience to offset that tax credit.
Yeah.
And regardless of what they've heard before during COVID, regardless of what the agreement is with HMRC, we have to assume it's netted off.
Yeah. Okay, I've got a question here. Any personal guarantees, or is it just against the assets in the business?
It is primarily against the assets of the business. We are a business-to-business lender. The only time where personal guarantees is to get comfortable that what has been said, what's been agreed, that type of future investment, which might or might not happen. You never quite know whether it could be an Elon Musk who tries to pull out of a deal or something like that. We sometimes need more confidence. But at the end of the day, we're a business-to-business lender, and the majority, if not 80 to 90% of the loans we provide do not involve personal guarantees.
Okay, thank you very much.
Oops, sorry, I'm on page too far.
The other thing which, why do businesses want their money early? As I said, either it's due to that fast growth. Sometimes the actual money, which is classified as working capital, can be reinvested in R&D. So what we've recently experienced with the future change in R&D tax credit rates, we've seen a lot of businesses try to scale up the R&D while they get a better return. In other ways, we see grants where there's a very interesting businesses where they're moving from one grant into that next grant, that larger grant, that multi-company grant, which are very much, to help with the impact investing, the environmental social governance that we very much support. Those types of things is where they want to increase and improve that expenditure earlier on, so they can continue to remain ahead of their competition, accelerate their R&D and growth, and continue in a strong position within the industry they're in. So that's where that cash flow, that working capital we're providing early, can be used in certain ways. I think naturally we don't want businesses to head off to Vegas and misuse the money. That's fairly obvious, but what we really want to do is make sure that business is supported and continues to grow. So here's an example of where that money that can be accessed earlier can be reinvested in the business.
Conscious of our time, Sam, we're all about innovation, accelerating, and helping companies grow.
And I think Hugo's experience has been really, really positive with you guys. I've got a question, just a very brief one. Do you loan against awarded patents? So one of the, that's the question. Do you loan against awarded patents?
We don't primarily. It's naturally in that we have been asked, do we lend against film tax credits, other forms of creative tax credits? When it comes to R&D, yes, we can. When it comes to grants, the majority of grants we can. Patents, not so much. In time, potentially, but we've only just started to scratch the surface of R&D and grants. So
I mean, ultimately, an awarded patent is not a guarantee to commercial success, is it? There's no, with a grant and with an R&D tax claim, there's a pretty good chance that you're going to get the money from the government agency within a defined period of time.
Correct.
Yeah.
But as you know better than we do, Sam, I think the government's getting slower and slower, and it's an ability. What we really want is to ensure that the businesses, aren't restricted by this.
Yeah. So, do you also lend against European funding schemes? So
Yes.
We used to have Horizon 2020, now it's Horizon Europe, and hopefully that will kickstart again in the next 6 months.
So we definitely do. So European Space Agency, Horizon Europe grants, we can lend against. One of the most interesting things and difficult situations UK businesses have experienced is they've won a Horizon grant, they expected an upfront payment, and under Innovate UK, it goes into arrears. So there's a big pinch point in the cash flows. And we've helped a lot of businesses in that situation where the grant's been approved by European Horizon Project, moved to Innovate UK, and instead of getting the money up front, it comes at the end. And that's a perfect example where it's just a simple mechanics of how we can help and make sure that project continues.
Yeah.
Naturally, the bigger the grant, the bigger the project, the more parties are involved. No one wants to misrepresent themselves, their company within that.
Perfect. Guys, that has been absolutely fascinating. For me, I've come across a few companies who have proffered to do this, but I think the speed with which you guys work and the straight up and down approach to what it is, that it's a very clean offering and that it can really help companies. If HMRC are delaying R&D tax payments, or you can get this at your year end, and that as a pathway for them getting their accounts in and the claim made, and you can bridge that gap. I think that is just brilliant for innovative companies. So a really strong proposition, and thank you very much for sharing that with us.
No, definitely. Well, Sam, thank you very much. And our 3 words are innovate, accelerate, grow, and we hope we can support businesses do that.
Perfect. Thank you very much, chaps. Thank you very much.
Thank you.
Okay, our final speaker is Lewis Stringer. He's absolutely, I think you're the regional manager for the British Business Bank. Is it for the whole of the Midlands or the East Midlands, Lewis?
Oh, Sam, you promoted me already. So
Wow.
I have the delight of representing the East and Southeast Midlands, Sam. So I can actually tell you I'm doing my job at the moment because I'm actually sitting in an office at Cranfield University.
Oh, fantastic. Fantastic. Anyway, Lewis is going to talk to us for the next kind of 25 minutes or so about the British Business Bank and the different ways that launches money into innovative companies. So yeah, Lewis, please share your screen and let's get cracking.
Great, thank you. So hopefully my slide is whirring away. Sam, I shall endeavour to give you some of your time back.
It's not come through just yet, Lewis.
It's still thinking about it.
Oh, is it?
It's going quickly.
Hey,
here it comes.
Here we go.
I told you I was in Cranfield, so it just takes a little bit longer to get to you. So,
all those supercomputers in the corner sucking the internet bandwidth, isn't it?
Probably that as well. Yeah. And first and foremost, Sam, thank you very much for the opportunity to present at the second Innovation Challenge and the first workshop of that second challenge. And well done to you, Joe, and the rest of the team at TBAT for a great initiative last year, and hopefully an even better initiative this year.
Thank you,
So,
Lewis.
without further ado, my name is Lewis Stringer. I'm a senior manager for the East and South East Midlands for an organisation called the British Business Bank. So first and foremost, do not worry if you've never heard of us. We are government's economic development bank, and our whole remit is to actually break down barriers for the UK small businesses to access finance. And hopefully over the next 10-15 minutes or so, I'll explain to you how we're doing that through a myriad of different programmes and delivery partners as well. So our mission is to drive sustainable growth and prosperity across the UK by helping businesses to transition to net zero by accessing access to finance to grow, innovate and grow forward as well. So we operate across the UK, but part of the reason why you've probably never come across us before is because actually we don't tend to lend or invest directly into businesses. We work through what we call delivery partners. Those are funders, regulated funders, either in the general debt market or in the equity market. And some of the great speakers before me have talked a little bit about debt and equity. And I'll explain what we're doing as UK government to make it easier for you to access those different types of products. We operate through, it says here 218 delivery partners. I would argue probably close to 250. And that's part of our remit as well, is to give you as UK SMEs greater choice and options. We were born out of the economic crisis of 2007, 2008. Sam's not old enough to remember that. I am, sadly. But again, that big issue going back over 10 years ago now was a lack of liquidity in the marketplace. What that did highlight for UK government and policymakers was an over-reliance on high street lenders. And what one of our remits says is to actually give greater options and to remove that over-reliance. And I'll talk about what that actually means in numbers going forwards as well. What we're also about is addressing some of the disparities that exist in terms of access to finance for SMEs, whether it be where they're located, gender, ethnicity, age, track record, availability of collateral, some of the common issues that you may have come across either previously or currently when you're looking to access finance, whether it be debt or equity funding. So what does all that mean, Lewis, and what do you do with the public money? Because actually, in reality, the majority of the funding that we get comes from government, it comes from their balance sheet, and then is ultimately your money as taxpayers in the UK. And what we basically do is that we identify gaps in SME access to finance. We develop programs, and I'm going to use the word state aid, Sam. I can't use that other word at the moment. I'm just not used to it. I mean, you probably are by now. Somebody's tried to unmute me already. That's very fine. I often get that. Is that we currently work with a whole myriad of delivery partners, whether it be debt providers, asset finance providers, equity providers, angels, and you've heard a lot of those terms and terminology. But we put government money through those delivery partners to get them to actually fill those gaps that we've identified through those programs. It's no more or less complicated than that. It is quite complicated, but that's not for us to worry about today. Who do we work with? As I said, we operate with more than 218 delivery partners. Some of those logos on that slide you'll be aware of. But what I think the important point here is that following 2007, 2008 and our development as an economic development bank, there are lots more choices, lots more names in the marketplace, lots more options in terms of how you can access finance. And Rocking Horse is a great example of an innovative way in which you as an SME can access finance other than the traditional way of 10, 15 years ago, where you effectively could just only take a bank loan. So where do we sit in the marketplace? We are very much at that early stage, whether you be a startup, pre-startup, a business looking to scale up. And some of our activity is about helping businesses to stay ahead. So we've been at the forefront of the COVID-19 initiatives over the last 3 years, providing government guarantees to lenders to ensure that money continue to flow into businesses, despite the previous and current problems that we're all experiencing economically. This is a busy slide. The slides are going to come out, But again, and I think it talked a little bit to Roger earlier, in the different types of funding, whether it be debt or equity funding, will be better for you depending on what stage your business is at. So this is my very simplistic approach to a life cycle stage map that I think we've all come across before. But clearly certain types of funding will be more appropriate depending on what stage the business is at, what level of collateral and security you've got, and how the funder perceives you from a risk perspective. So we do a whole host of different things in terms of the debt side. I'm going to talk a little bit about startup loans because I'm conscious that some of the audience may be at a very early stage in their business. I'm going to talk a little bit about our regional funds, and then the other schemes are